It is 9 a.m. here in New York City, and this is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. Here are the three things that you need to know to start off your morning. Walmart pushes past the economic doom and gloom. The nation's biggest retailer lifts its full-year guidance after fiscal first quarter sales jumped almost 8%. Groceries were the savior there, offsetting a weaker performance for electronics and clothing. Same-store sales rose 7.4%, while its e-commerce business rocketed. The report shows consumers trading down to smaller sizes, solidifying the narrative that discretionary spending is taking a back seat. It comes following a similar theme from Home Depot and Target this week. Now, the big box retailers' revenue came in at $152.3 billion, that comfortably beating the street. We'll talk consumer trends with the CFO, John Rainey, this hour. President Biden is 7,000 miles from D.C., but he can't escape the debt ceiling debate. His trip to Hiroshima being overshadowed by the impending X date back home. It could come as early as June 1st, according to Treasury Secretary Janet Yellen. House Speaker Kevin McCarthy says a deal to raise the limit is, quote, doable by Sunday. That's the day the president is expected to hold a news conference on the issue. A higher-level team of negotiators has been trying to narrow the framework in recent days. We speak with Democratic Senator Chris Van Hollen on his legislative drive to avoid the dreaded default. And TikTok has its first ban in the United States. Montana has become the first state to ban the ByteDance-owned app, with the governor labeling it a tool used by the Chinese Communist Party to spy on Americans. Debate has raged in recent months over whether the popular app is effectively controlled by authorities in Beijing. There hasn't been any direct evidence of this yet to date, and the ban applies to platforms offering the app, including the Google Play and Apple App Store. TikTok will likely challenge the ruling in federal court.
And shares of Walmart are trading higher pre-market by about 2% after beating on first quarter earnings. The stock getting a bump as the company lifted its full year guidance. And the nation's biggest retailer seeing strong revenue growth, up 7.6% on an annual basis. Comp sales growing at a similar annual pace, up 7.4% in the United States. And the global e-commerce business growing double digits, up by 26%. Walmart with a profit beat as well. Adjusted earnings per share coming in at $1.47 compared to $1.31 estimated. So as we look at these numbers, it's kind of like, it's interesting. It's a very different story from Target. But if you've been listening, Brad, to the folks we've been talking to over the past few days, it's not necessarily a surprise, because the idea that Walmart has a much larger share in groceries, is seeing more of a trade down effect in that area in particular. That seems to have helped it. Yeah,
it's all about where Walmart's, to your point, on the grocery side of the business, is already getting so many customers in stores, or has that regular or cyclical week in, week out type of engagement with them, but also into some of the discretionary categories where consumers might not necessarily be trading down fully as what other retailers might be saying, but where they might be more selective about the price that they are taking on. And I think for Walmart and how they've been able to drum up specific partnerships in those discretionary categories, namely clothes, apparel categories, particularly here, being looked at as a potential hedge against some of the higher spending that consumers may do elsewhere. I think that's exactly where Walmart is able to lean into that. And then additionally here, it's interesting to see the divergence between the e-commerce threads that Walmart is drawing versus a company like Target. We saw e-commerce weaker, digital sales weaker over at Target, but Walmart, they did see growth of about 23%, as I'm trying to pull up my notes here. 26% globally, yes, global.
Yeah, so a couple other things to mention here. International sales were also strong. That's an area that analysts were watching, up 12.9% to $26.8 billion. China sales rose by 28%. And then looking at Sam's Club, which obviously is another important part of the operation, comparable sales there up 4.5%. If you back out fuel, that rise goes to 7.4%, since we know gasoline was a bit of a dampening on retail sales overall. E-commerce within Sam's Club specifically, up 19%. So the various areas of the business performing well. And I'm also looking at some of the early headlines from the conference call that's been going on for about an hour. I actually don't know if it's still going on, but these were some of the headlines. Doug McMillon, the CEO, saying that the company is gaining market share in groceries, which is something that we have been seeing. It's not necessarily a huge surprise. He also said that the company's making gains with wealthier and younger shoppers, which is interesting. Those folks are migrating, right? Yeah. They want to save money maybe on the grocery side, so they're going there, which is quite interesting. At the same time, the CFO, John David Rainey, saying that there are signs below the surface of stress within the consumer. So interesting here. And the company did say that the sales momentum moderated as the quarter went on. Mm-hmm. It is raising that full year forecast, but that's an interesting thing to pay attention to as well. Absolutely. We're going to have much more on this discussion. We're going to hear more about those results later on this hour when we speak with Walmart's CFO, John David Rainey. Do not miss that discussion. But it's time now for today's morning brief. We're 2 weeks from the debt default ex-date of June 1st. The latest talks Tuesday between President Biden and House Speaker McCarthy were somewhat positive. Both leaders left the meeting optimistic. Biden is overseas for the G7 summit, until Sunday, and aides from both offices will meet in the meantime. Despite all of this, the market seems unconcerned a bit, but are investors right to feel so calm is the question. The last major debt crisis in late summer of 2011 saw markets tumble as a deal was reached just days before the default date. Debt ceiling fights are nothing new, and Congress has raised the limit more than 70 times since 1960. But what if it went away? Enter the 14th Amendment, which contains a clause that the validity of the U.S. debt shall not be questioned. Legal scholars argue that the president could invoke the clause, claiming it's his constitutional duty to bypass Congress and raise the limit himself. In April, Maryland Senator Chris Van Hollen helped reintroduce legislation to eliminate the debt ceiling altogether, calling it an economic time bomb. He joins us now. Can you break down that comment further and calling the debt ceiling an economic time bomb?
Sure, and it's great to be with you, Brad and Julie. Well, we're witnessing the ticking time bomb right now, which is you've got Speaker McCarthy. He has his finger on the default detonator, and he's been saying that if we don't do things his way, he would allow us to default on our debts for the first time in our history. And I think all economists agree that would be economically catastrophic. So the question is, why do we continue to have this ticking bomb within our code? And my view is we should diffuse it before one day it actually explodes and does a huge amount of damage to our economy. Right, and we got an inkling of that, right, back in 2011 as we were talking about, Senator. One of the options that's been floated, as we mentioned, is the invocation of the 14th Amendment, right? A number of your colleagues in the Senate have signed on to a letter calling for the president to take that measure. Are you going to sign on to that letter as well? Do you think that that is a viable option? Well, I certainly think, number one, we cannot default. Number two, the best way to resolve this at this moment would be for Speaker McCarthy to be reasonable and come to an agreement on the budget and the appropriations levels. I really worry that as a weak speaker, he doesn't have the ability to deliver the votes in his caucus on any reasonable agreement. So I do believe that the president should be exploring all legal options to prevent a default, and that would include the 14th Amendment. So I certainly hope that the administration is looking at that very carefully, not as Plan A, but as Plan B. So that sounds like you're not going to sign on to that letter with your colleagues, but at least you want the president to leave all of his options on the table. Absolutely. It would be catastrophic if we defaulted, which is why I support this legislation to diffuse this economic weapon by passing a statute. But we don't have time to do that right now. So again, Plan A, let's try to get a reasonable agreement on the budget, not just on the debt ceiling, but on the budget, so we can also avoid a government shutdown. But if that doesn't work, excuse me, then I do think the president needs to look at the 14th Amendment. As it stands at this hour, where are some of the biggest cuts within the budget that are being considered, and where is that money being reallocated? Well, the cuts are very deep for this reason. the House Republican plan says we'll go back to 2022 levels, but there's a very important catch to that, which is they then say they're going to take defense spending off the table, which is about 50% of the total discretionary spending. So we're talking about cuts to areas of education, kids' health, the elderly, of around 35%. These are huge cuts that would really hurt working families, hurt kids, and others. And of course, they also want at the same time to repeal the Inflation Reduction Act, which includes very important investments in clean energy to help make the transition to a greener economy. Part of their plan is to essentially get rid of that. So what the House Republicans have put forward is a non-starter. And the president is absolutely right to say two things. We can't negotiate while if you're really going to threaten to default. But we also do need to come to some agreement on budget appropriations level. So I support the ongoing conversations. I will say I'm very much in the I'll believe it when I see it mode, because everything I've heard from Speaker McCarthy suggests that he cannot deliver on a reasonable deal.
Senator, and as we mentioned, you had introduced a bill to sort of get rid of this situation altogether going forward. Given the divided Congress, it doesn't seem like that has much chance of going anywhere. But this happens, right? This keeps happening over and over again. When the Democrats are in power, it goes a different way depending on who's in power, right? Where we see this as sort of this negotiating tactic. Do you see a point in the future where there can be enough bipartisan agreement to get rid of the debt ceiling altogether?
Well, I hope so. And that's why I joined Brian Schatz, Senator Schatz, on this bill to get rid of this ticking economic weapon. Excuse me, because I hope it does not come to the point, Julie, where in order to get rid of it, we have to have experienced the catastrophe. That's what I worry about. I worry that, some people won't come to their senses until we've actually seen an economic meltdown. And of course, then it's too late. So this is why many of us have been pressing for some time now to make the change, during a period of relative calm. But unfortunately, we don't have the votes. That's partly because there's still a lot of confusion in the public mind that the debt ceiling is about increasing spending rather than what it really is, which is making sure that we pay the bills that are already due and owing. It's just like you and I can't get up and say we're not going to make a mortgage payment or a car payment without any consequences. Well, if the United States and Uncle Sam wakes up one morning and says, we're not going to pay any of our bills on time, that will crater the economy. Not only that, it will be irreparable because people overseas will lose confidence in the dollar as the reserve currency, which of course is something that President Xi of China and President and Putin have been trying to do for a very long time. So we would be doing to ourselves what they've been unable to do, but what they want to do, which is to take down the United States as a global economic leader.
Senator, switching gears here and pivoting from the debt ceiling conversation to the issue that you have been monitoring and discussing on Capitol Hill with regard to the financial services industry. You actually serve on the Senate Banking Committee on Housing, Banking, and Urban Affairs, and fortuitous time for us to have this conversation because you've been in the throes of some hearings that have been taking place. Tuesday, you had the Silicon Valley Bank hearing, and then now today, you're also meeting and hearing with financial regulators. In the realm of these conversations where you're able to have not just the questions about what transpired and what went wrong, but what changes need to be taking place in the future, what would you like to hear? What do you need to hear from regulators to get a sense that everybody has a firm grasp on what needs to be done from this point?
Well, sure. And first, should say this is directly connected also just to the default debate, because if we were to default, you'd see interest rates go up even further. You would see more bank failures like we saw with Silicon Valley Bank. So that's very much connected to the default debate as well. But on an ongoing basis, we need to make a number of changes. Number one, in my view, you should not have a bank that has so many unsecured deposits. I mean, Silicon Valley Bank had about 90% of its deposits were unsecured by FDIC. And yet it did play an important role in our economy. And so I think that we should not have the FDIC insuring banks going forward that have such huge unsecured deposits, meaning deposits above 250,000. How you get from where we are today to a less risky system is something we have to work out. I also think we need to look at executive compensation. Look, we had the chief executive officer of Silicon Valley Bank before the banking committee the other day. You know, I asked him whether he really thought he deserved a $1.5 million bonus just weeks before Silicon Valley collapsed and the FDIC had to come bail them out with respect to the depositors. And he said yes. And when you look at their record, what they did was they tried to artificially boost short-term profits in a way that put at risk the soundness of the bank and depositors. They took a huge gamble. They lost, and the FDIC then has to come bail it out, and he gets a bonus. So number one, I think we need a better mechanism to claw back these wrongful bonuses that were gained by executives who were making grossly negligent decisions. But I also think we need to look at how we structure executive bonuses going forward, so there's not an incentive to take such risky bets simply to get a bonus at the expense of everybody else.
Senator, just to make sure I understood the first part of what you're thinking about correctly in terms of FDIC and deposit insurance limits. So you think that in order for a bank to be FDIC insured, it will have to have a certain percentage of its deposits that are below that $250,000 limit, if I'm understanding correctly, and ballpark of what that percentage would have to be?
Well, yes. I don't put it this way. I know it's too high. 90% of deposits is too high. Where the right number is, I think, is something we need to look closely at. If you look at the sort of FDIC's, post-mortem report, they also raised this issue. And the question now is, what's the best path forward to making sure that we don't have a situation like we had with Silicon Valley Bank.
Maryland Senator Chris Van Hollen from the great state, my home state of Maryland. Good to talk to you as always, Senator. Appreciate it.
Good to be with you. Thanks, Julie.
Thanks. Well, as we've been talking about, we're fast approaching the date the U.S. could default on its debt for the first time, though still seen as very unlikely, at least by market participants. It's dominated the headlines in recent weeks. As that deadline approaches, Wall Street, however, doesn't appear that concerned. Over 70% of respondents in Bank of America's latest fund manager survey said they do expect the government to reach a resolution. This as investors enjoy positive returns year to date, seemingly looking beyond the current day-to-day concerns. Let's get more on the impact from markets with Oppenheimer Chief Investment Strategist John Stolfus. John, it's great to see you. Just heard what we were talking about with the senator there. The market thinks something is going to get resolved here. Does it matter how? In other words, if it's an 11th hour agreement, if it's the invocation of the 14th Amendment, whatever it is, does the market care how it gets done?
Well, thanks for having me on, Julie. Always great to be on with you on Yahoo Finance. Let me just tell you, I think it does matter in the sense that they got to come to a deal, not a dramatic, it can be an 11th hour agreement, but not one of these things where they get into a whole constitutional argument about whether it's the right thing to do or the wrong thing. I think the reality is in the last 10 days or so, it began to be realized by the politicians on both sides of the aisle that whomever is tied or to whomever would be tied to a default of the U.S. would likely be committing political suicide. And that's why I think we've seen the positive developments since last week where they're bringing in the team members of both sides to carry on discussions, weekend discussions, day-to-day discussions, and then bringing in the chiefs to to show that they're behind this effort. So we feel remarkably confident, based on all the worry that's out there, that we're going to get a deal done. It might be an 11th hour, but they could even surprise us, because both sides do seem to realize, again, we can't stress it enough, and we wrote it about 2 weeks ago, it's political suicide is what we believe, because their constituencies, Lael Brainerd over the weekend said essentially, it would affect things like automobile loans, mortgages, retirees' paychecks, things like that. This brings it on home, and politicians know one thing, if nothing else. They know how to get reelected, and that's serve your constituents. Both sides of the aisle is what we'd say.
John, as we were just listening to the senator from the Oriole State, he was lining up some of the areas where we could see cuts, even as a result of the negotiations that take place. And if there's anything that investors can extrapolate from those areas, defense, education, healthcare, energy, and how they might come up in future negotiations, is there any type of pivot or at least repositioning they should be considering, knowing that those are some of the sectors that could be hit in future negotiations as well, even aside from this debt ceiling debate?
Well, I'd have to say this. It would appear that this time around, it's another take it to the limit one more time kind of event. I think it's beginning to get quite clear in Washington, D.C., that these are issues, as I said before, these are felt on Main Street, and what you mentioned. And when it comes to defense, the defense is recognized on Main Street because of our forces that serve around the world. As well as people, they watch the news and they see what's going on. I think, if anything, both President Xi of China and Vladimir Putin, in his incursion into Ukraine over the course of the last year, and President Xi's support, as much as it's been supportive of Putin, essentially has awakened people to the fact that a military problem does exist. It's not just about trade.
Yeah, most definitely not just about trade. And I should say also that the market action right now isn't just about the debt ceiling. It isn't just about geopolitics. It's about the Fed. And with that, I want to bring up some comments that we got from Dallas Fed President Lori Logan this morning, that the economic data we've gotten thus far does not justify skipping a rate increase at the June meeting. I think that caused a little bit of early market consternation here. What do you make of that, and what do you think happens in June?
Well, Julie, we've been big believers that the Fed would be likely to raise another time, 25 bips in June when it comes out of that meeting. The economic data of late, particularly related to inflation, has shown that the Fed most certainly, its activities to remove hyperliquidity from the system, and a period of free money, essentially, which is not good for anybody, really. What they are essentially doing here is battling inflation, and they've been remarkably successful versus all their naysayers have said they would fail, in that they have cut the CPI, both the core, as I recall, and the headline number, just by about half, not quite half. And they've still got another half to go to get close to that 2% marker. So we think they're going to raise again. We don't think they're going to cut this year the way some people think. And we think overall, the market, while it has some of the best heard voices on Wall Street, we would say, are those who talk about cuts and things and expectations like that. We'd say the underlying trend is we think that the market has a goal beyond, and is looking to resolution of this debt ceiling business, is looking for the Fed to continue to be very sensitive in activity. If we consider that it did raise 4 times in a row, 75 bips, then dropped to 50, then to, these 25 bip cuts, this is likely to go on for a while.
So John, just quickly then, let's say hopefully the debt ceiling crisis is wrapped up by the time we get to the Fed's meeting. Let's say they raise. What is that going to do to the market? It doesn't seem like that is necessarily priced in right now.
Well, the thing about it is I think the news from the Fed, at least up through the most recent hike, was expectations of a hike. And if you look at the performance of the S&P 500 sectors on a year-to-date basis, it is not all technology. It's, communication services, which is heavy in tech, up 29%. Information technology, I can't believe this myself looking at it, but since the end of last year is up 25%. Consumer discretionary is up 17%. And staples is only up 1.86%, which is a defensive sector. So the market is showing a remarkable confidence. It's also some of the developments around AI, of course, have boosted sentiment towards technology naturally, which was brutally oversold last year. And lastly, I know that we ought to roll on this, it related to consumer discretionary. The consumer has been remarkably resilient, not necessarily robust, and has become more cautious, but compared to where we might be in other cycles that were tightening cycles, we're doing remarkably well. And some of that may have just been the overstimulation.
Yeah, you mentioned the magical potion that AI has seemingly been over the course of this earnings season. Earnings season is wrapping up, so let's take a look back at what we've learned this quarter. Sure, we've seen more beats than misses, but that's not the real story here. Among the 11 sectors of the S&P 500, only 4 are showing earnings growth, while 7 are seeing decline. And the consumer discretionary, one of the biggest winners this season in that sector, with double-digit earnings growth showing resilience in the U.S. consumer. John Stolfus is with us, and for this earnings season scorecard here, John, what grade would you give it?
I would say I'd give it a B+. How's that? I hope I'm not too liberal a professor giving it a good grade. But
why is that?
When I look at it, just think of it. We've got energy, which you would expect, double digits. Right now, I'm looking earnings up 13.73%, industrials up 20.36%, and consumer discretionary up 23.8%. Now, that's 3 very cyclical sectors, and they're also, curiously enough, they're value oriented, and they are they're showing double-digit earnings in a tough environment, wherein we saw oil prices roll back considerably, even with the OPEC Plus announcement and all. Oil is not like headed to the moon yet. And so what we've got to say is especially consumer discretionary and industrials, this is, it shows an interest in fundamentals. And when we see the worst, I'm looking here on my screen here, I think the worst performer is materials, which would essentially say, it's not about mining stocks at this point, really, if we look at it in terms of where the vote is coming from earnings results.
When I listen to the commentary from many of these companies, though, they do sound more cautious, and particularly since we're in the midst of the consumer discretionary reporting season with Target, with Walmart, although Walmart's more of a staples, I guess you could argue. But the point is, a lot of them are saying people are still not spending on larger ticket items. They're expressing some caution. Do you think they're just sort of managing expectations lower? Or do you think, are you concerned about that kind of a slowdown in the second half?
Well, a couple of things. One is we saw, robust consumer activity as a result of all the stimulus during the pandemic, and then immediately coming out of it, then a shift from goods to services. And when it comes to the companies and how they position themselves, I can only remember most of last year, wasn't it the great headline all the time was 98% of corporate chieftains were saying that we were headed into a recession, but when they were asked about their own business, they tended to be cautiously optimistic. And in this case, I think what they're doing is they're just trying to reduce expectations, as you say, offering an opportunity to surprise to the upside. But also the reality is there is a lot of uncertainty out there, but that tends to be what the market likes when people have been the investment community, market participants on a broad basis have been overly negative. And we have been seeing some fairly hardcore bears of late in the last few days beginning to look like they're pivoting, if not exactly like capitulating.
John, thanks so much for helping us break down and put a bow on this earnings season. I mean, of course, there's still a few more companies to come, some household names, but that is John Stolfus, who is the Oppenheimer Chief Investment Strategist. John, always a pleasure to speak with you.
Thank you.
Absolutely. Montana becomes the first state to completely ban TikTok. The governor saying the ban will protect residents from the Chinese Communist Party. There's been debate in recent months over whether the popular app is effectively controlled by authorities in Beijing. There hasn't been any direct evidence of this to this date. TikTok's ban will be in effect January 2024 in the state, but may not even last that long. Our own Dan Halley is diving deeper into what this ban means for TikTok's future in our next hour. You don't want to miss that.
And right now, you don't want to miss the opening of cash trading here. We got the opening bell on Wall Street because it's 9:30. So let's get a check of the markets sponsored by Flex Shares. As we said earlier, we got some commentary from Dallas Fed President Lori Logan, who said she's not convinced that the Fed should indeed pause in its rate increase cycle at its June meeting, given the recent data that we have gotten. We've got that to contend with. We have continuing retail earnings to contend with. And so we are seeing a mixed picture to open up here this morning. The Nasdaq up just 0.1%. The S&P, call it little change, slightly to the downside. The Dow off by 0.1%. And I mentioned those retail earnings, shares of Walmart. We're watching those closely. That's after the first quarter earnings came in stronger than estimated. Walmart beating on the top and bottom line, lifting full year guidance as well. We're seeing strength in the grocery segment in particular, offsetting a weaker performance in apparel and electronics. Walmart's e-commerce business skyrocketing over the last year. Let's break all of this down with Walmart CFO John David Rainey alongside Yahoo Finance's executive editor Brian Sozzi. John, thank you so much for being here. Really interesting numbers and quarter from you guys. Talk to me first about the sort of give and take that you guys are seeing in the store, the grocery side versus more discretionary items, and what trends are looking like right now.
Sure. Well, it's good to be on the show. And first, I'll say that we had a really strong quarter. We're pleased that revenue, our top line, was able to grow over 7%. But I think very importantly, we saw that our operating income grew at 17%. And what this demonstrates is that the value proposition, our value proposition, is really resonating with customers. But we continue to see, as you noted, a mix shift in our business. As consumer wallets are stretched more thinly, they're shifting more of their dollars to purchasing items like food and consumables and less away from general merchandise. And overall, that does have an impact on our business because general merchandise tends to be higher margin for us. But even despite that, we were able to grow operating income in the quarter 17% and increased our guidance for the year as well.
John David, Brian here. Good to get some time with you. You mentioned on the analyst call this morning that sales moderated as the quarter progressed. Why do you think that was the case? And then bigger picture, how financially stressed is the core U.S. shopper at Walmart?
Yeah, the moderation did occur in the quarter, and there's a couple reasons, Brian, to point to. I think one is just headline inflation rates are coming down. That affects our revenue numbers as well. We're beginning to lap some of those periods of higher inflation last year. But there were also a couple key trends in the quarter that affected our business and the macro economy at large. And so one of those I'd point to is SNAP benefits. Those abated during the quarter, and that we tend to see that spending patterns follow that as well. We also saw overall for the quarter a reduction in year-over-year tax refunds. And the way that played out in the quarter, earlier in the quarter, we were seeing increases in year-over-year tax refunds. For the quarter in total, it was down 10 or 11%. And again, spending trends followed that. And then lastly, and this was a good guy for us, but we saw an increase related to the cost of living adjustment with Social Security. And that happened earlier in the quarter. And so all these things combined kind of impacted the cadence of revenue growth in the quarter. And so February started off really strong, and then we saw a little bit of a drop down in March and April.
John David, Brad here. Would love to know in terms of the digital and the e-commerce business, and you've invested so much into that over the past 7 to 10 years, and it's really paying off here over time. I'm just wondering, as you think about further investment into that technological touch point with your end consumer, how you're seeing some of the members of your rewards program or those that are kind of closest to Walmart as a subscriber base, how they're continuing to engage with the brand and where they're even continuing to spend on an average basis, if there's any figures that kind of have been elucidated over that time in the investment in technology.
Sure. Well, our e-commerce business was up 26% in the quarter, and I feel like we're really hitting our stride here. Our value proposition is resonating, but it's not just around price. It's also around convenience, and that matters irrespective of what your income level is. And so things like online pickup and delivery continue to grow at much faster rates than the rest of our business. And when you have value like that, when we provide value like that to our customers, you're willing to subscribe to a membership where you have the utility in that. And what we see among those members is that about 50% of them actually come from the channel of online pickup and delivery. And the spending related to that they are appreciably higher than what an average Walmart customer is. So we want more people to avail themselves of the suite of benefits that we provide for our customers.
John David, how concerned are you that you guys mentioned on the earnings release, still seeing double-digit food inflation? Now, we have gotten a series of rate hikes over the past year and a half. Supply chains have improved, but we're still hearing from Walmart double-digit inflation. What's causing this, and any relief in sight?
Sure. Well, our guidance for the year really has sort of finally balances a cautious outlook on the consumer with some conviction in our own ability to execute on our strategy. But you're exactly right. If you look at the headline numbers, sure, inflation is coming down because we're lapping higher prices last year. But if you're a consumer going to buy a basket of groceries, prices are still high. If you look at food prices on a 2-year stack basis, they're still up 20%. And so pocketbooks are pinched, and that's causing customers to be more discretionary with these larger ticket items like electronics, TVs, home, and apparel.
You said on the call that you are seeing signs of stress on consumers below the surface. Is that the kind of thing that you're talking about? What else can you tell us about those signs of stress?
Yeah, it's the same thing that we saw in the prior couple quarters as well. When consumers are coming to our stores, we're seeing trade downs in terms of buying less expensive meats, or instead of buying a pack of 12, they're buying a pack of 6. You can see that their wallets are being stretched more thinly. And when you look broadly, I look at the same economic data that you do, but there are other indicators. We're seeing credit as a funding instrument, as an example, be more elevated to where it was in prior periods. You're seeing delinquency rates on credit cards in general tick up. And so there are these signs that there's some fraying in terms of the consumer health, and we're keeping a cautious outlook on that. There's a lot that we don't know about the back half of the year, and we want to be prepared for any type of economic environment.
John David, we've heard some of your competitors, Target, some of the pharmacy store chains as well, have talked a lot about what you in the retail industry call shrink, which sometimes is a euphemism for theft. It seems like some of it is organized crime coming into the stores, stealing lots of stuff. What are you seeing at Walmart? And to you, is that also a sign of the times and economic stress, or is there something else going on there?
Yeah, well, I certainly think it's related, but to be clear, this is a problem for all retailers. But our main focus at Walmart is protecting our associates, protecting our customers, but also protecting our merchandise. But this is not an issue that one retailer or either the retailers at large can solve by themselves. We need engagement from the local communities to help solve this.
John David, of course, Walmart is very much an international company, and one slide that stood out to me in your presentation is China. Some very big sales growth numbers there. What is driving that, and what is the outlook for your China business in the back half of the year?
One of the things that I love about our China business is how penetrated we are into e-commerce. That business is roughly 50-50 in terms of brick and mortar versus e-commerce. And I think it's a great indication of how to think about our business at an enterprise level into the future. But you're right, China was a real bright spot for us in the quarter. A part of that was the economy reopening, but we also our team did a very good job making sure that we had the right merchandise in the right place to respond to the seasonal demand earlier in the quarter. So really pleased with the progress that we saw there, not only from a top line perspective, but bottom line as well.
John David, we know you talked in the past, and Walmart has, about what the future of retail looks like, especially with AI. And AI, of course, has been the flavor of the earnings season, or 2 earnings seasons at this point. For Walmart's perspective, beyond a frictionless cashier or kind of grab and go type of experience, where else do you see AI perhaps improving some of the seamlessness for the business as a whole? And does that have any broader implications for things like headcount too?
Sure. Well, we, like all companies, are keeping a close eye on AI and making sure that we're appropriately applying that to the aspects of our business that we think are additive. And certainly the most obvious examples are around how we can improve customers' and members' shopping experiences. So tailor offers to them that are based upon their own individual preferences, their past buying patterns. But there's a lot more to AI than just what we can put in front of a customer. When we look at our own supply chain technology that's in some of our distribution centers, we use AI in there with our robots. And so a robot has to go from point A to point B to retrieve inventory to put out to our stores. The route that they take is optimized through AI. So if they have to take a more circuitous route, they're learning from that and trying to become more efficient. That helps us lower our costs. It helps get goods in front of the customer faster, and it's all around a win-win.
Do you have a number, John David, this year on how much you will spend on AI-related technology?
We don't have a number that we're sharing, but we spend a lot on technology. We are a very technology-oriented company. We talk about being people-led and tech-powered as an omni-channel retailer. And so we spend a lot in technology, and we try to put that in front and create experiences for our customers that that give them the very best shopping experience.
John David,
Staying on,
oh, sorry, go ahead, Brian.
No, lastly, I'm just curious, John David, before we let you go, on the online business, why was your online business up in all three segments and Target was down?
Well, I can't speak to Target's results, but what I can tell you is that clearly our value proposition is resonating. Customers are coming to us. Online pickup and delivery is a big part of this. And Brian, this is like something that I think is a little bit unique around Walmart. You saw a lot of companies during the pandemic that benefited, that were more e-commerce, but you saw those trends revert post-pandemic. Not for Walmart. When you look at online pickup and delivery, our weekly average customers that are coming to us and engaging digitally, they have continued to go up and to the right post-pandemic. So we just want to keep those trends continuing.
All right, John David Rainey, thank you so much for being here, Walmart CFO. Appreciate your time this morning. I know it's a busy one for you.
Thank you. I appreciate being on the show.
Thanks. Coming up, Chinese e-commerce giant Alibaba beating estimates, but a big announcement on its cloud computing division stealing some of the headlines. We'll get into that next.
We're almost 15 minutes into today's trading session and checking in on the latest moves during today's activity. We have Yahoo Finance contributor Remy Blair on the floor of the NYSE with the details. Remy.
Well, Wall Street has opened on a mixed note on this Thursday morning, but this does come on the heels of the strong rally we saw in equities in the previous session. On Wednesday, the Dow, Nasdaq, and S&P 500 all settled higher, up by over 1%. Today, the latest earnings as well as economic data are being digested. Now, we did see weekly initial jobless claims decline by 22,000, which reversed the decline we saw in the week prior. Meanwhile, the Philly Fed Index showed a 9th straight month of declines in factory activity for the month of May. Now, moving on to market-moving stocks this morning, let's take a look at Palantir Technologies. We are seeing shares of that company extend gains from the previous session. Yesterday, we saw shares settle higher by about 8% on the session, closing above $10. And that is a level not seen since February of 2023. But we do have to keep in mind that its earnings beat was pretty good in terms of its top line as well as bottom line, and Palantir also raised its guidance for this year. Also to keep in mind, Palantir CEO Alex Karp did say in an open letter that he is moving full throttle in terms of its recently announced AI platform. We'll keep an eye on that stock. But notably, Cathie Wood's ARK Invest upped its stake in Palantir, adding over 1 million shares with a valuation about $13 million US, and this does come on the heels of Cathie Wood's prior investment after the earnings report. Now, moving on to regional banks, we saw that sector gain in the previous session. And in today's session, we are seeing Western Alliance as well as PacWest try to extend those gains. We saw that pop in the sector come on the heels of Western Alliance, showing that bank deposit stability is here. It reported in a regulatory filing that deposit growth ballooned by nearly $2 billion since the beginning of Q2 of this year. As a result of that pop in Western Alliance, we did see other regionals, including the companies of New York Community Bancorp, KeyCorp, Comerica, as well as Truist Financial and Zion Bank Corporation gain in the previous session. And this morning, it does look like those companies are trying to extend session gains.
Thanks, Remy. Interesting to see, those regionals continue to recover a little bit. Appreciate it. Let's talk about some other movers as well. Chinese e-commerce giant Alibaba beating estimates on the top and bottom line. The company also announcing it's going to spin off its highly prized cloud computing division via a stock dividend to shareholders. The shares are down about 2%. We had been waiting for details of what these spinoffs were going to look like. But at the same time, even though the company beat, domestic commerce was down by 3%. Its cloud division revenue was down by 2%. So that seems to be one of the things that's putting pressure on the shares this morning. Even though the headline numbers look good, the domestic commerce business is huge, right? I mean, if you're looking at this as the, akin to the Amazon of China, and the commerce business isn't doing well, and the cloud business is seeing declines, then that, is not great news. But it is interesting to hear about all the various separations that Alibaba's doing as well. Yeah, 6 different businesses. They had essentially kind of earmarked here, and for the cloud unit, I think investors have a lot of focus on this specifically because of the margins that Amazon Web Services sees from their cloud business, or that Microsoft sees from its own. All that said, for Alibaba rather, what some of their challenge has been is crossing hemispheres and making sure that that cloud business sees even more of that potential client base grow out in different regions here. And so perhaps there's still a growth effect that this could go through, but at this point in time, I think for Alibaba and the 6 different units that they had already talked about splitting up, this was one of the most watched ones simply because of the profitability metric that a lot of investors would be looking for. Let's also talk about shares of Cisco. Those shares are under pressure this morning, but not under much pressure, actually. They were down more earlier. Orders, the company said, fell 23% in the third quarter. They blamed a large backlog of products and lower demand from customers. Cisco did forecast modest revenue growth in 2024. So it's that sort of push and pull that seems to be affecting the shares here. The sales forecast was above estimates. That order growth or the order decline in the last quarter. So that's the sort of balance, if you will, in this environment. And Chuck Robbins, the CEO, did say demand is staying steady. Mm-hmm. He says an earlier increase in product shipments meant customers needed to absorb these shipments, right? So you're seeing sort of the disruptions in ordering that we've seen in a lot of companies. Yeah, and for anybody looking through an earnings report or even listening into a call like Cisco's, you'll often hear about what their ARR is, that annualized recurring revenue, or even some of the RPO and their remaining performance obligations. Remaining performance obligations essentially give them kind of this pipeline that they can deliver on. And that total short-term obligation grew to $16.9 billion. Total product orders, as you mentioned, were down, actually. That was a little bit of a hit by about 23%, driven by a few of the factors, including macroeconomic, that Chuck had pointed out earlier in the call, essentially saying that global customer advisory in the board that they were able to kind of meet with earlier in the month. They're still investing in key technologies. They're still trying to grow out that portfolio base, but they're also moving towards more of a solution services or subscription based revenue kind of pie here, if you think about it. And so 82% of their software revenues were subscription based, and that's where they can perhaps lock in a little bit more recurring revenue, which is what investors might start to give a little bit more weight to in terms of a metric that they look at when they do hear of any of the Cisco business updates or quarterly earnings reports. Right. I guess judging from the stock reaction, it seems like they are sort of buying that narrative. Yeah. It seems that it's not worse. Not worse. Yeah. Let's also talk about shares of Take-Two. Rob Base's perhaps favorite stock here. Anyway, Take-Two rallying today after the company beat analyst estimates on the top and bottom line in the latest quarter on strong demand from legacy titles, NBA 2K and Grand Theft Auto. The company also said that it expects to deliver 36 video game titles through 2025 and 2026 here. So that's significant for Take-Two. We are taking a look at the actuals versus some of the estimates that came in. And just to put some numbers on this, NBA 2K and Grand Theft Auto shares for the company, as you were seeing them move higher here during the market activity, the adjusted sales grew by 65% to reach that $1.39 billion marker here after the fourth quarter. So that is particularly interesting, and of course, just the Take-Two slew of content that they've been able to pump out at this point is significant just in terms of the equity that they have in some of those names. But it's just a matter of, all right, is this other deal that's looming over the rest of the gaming industry gonna be a major competitive kind of headwind? The numbers were decent, right? The company's forecast is below estimates. It seems like a lot of the chatter this morning is around Grand Theft Auto 6. Ooh. That it might come out in fiscal 2025. So there's a lot of chatter about that. There's a lot of optimism around that. So yeah, the stock is higher on the numbers, but it really seems like the extra lift, if you will, the outsized lift, has to do with speculation around GTA 6 this morning. Absolutely. The enthusiasm around that. Part of their portfolio management measures that they talked about during the quarter. Also, everyone, coming up on the other side of this short break here, you talked about Take-Two a moment ago. We'll talk about a tale of two coasts. We'll check in with some key housing data as the nation continues to see an east-west split. Oh, no. More next. About 25 minutes into the trading session, let's take a look at what is moving here. We've got energy and materials that are back in the red here. Those groups, I should say, commodities have been pretty volatile as of late. We've got tech and communication services as well as consumer discretionary that are balancing that out in today's session. If you look at where it all equals, again, we're early moments here, but we've got the Dow off by about 0.4%. The Nasdaq is up a quarter, and the S&P is little changed. Over on the trending ticker list, we've got some of the earnings that are still rolling in that are on that list. We just talked about Alibaba a few moments ago with those disappointing domestic commerce sales. Walmart hanging on to its gain of 2%. We've been talking about some of these other movers here. Micron getting some new investment in Japan to build out some chip facilities there. Those shares are up about 4%. We also have Lightspeed trading lower this morning following its earnings report. We're actually going to be speaking to CEO JP Chauvet a little bit later on. This company makes software for restaurants, for retailers, sort of point of sale and booking software. So we'll talk about that a little bit later. And Canada Goose as well, up by 3% after that company came out with disappointing numbers. So still a lot of focus here on the various earnings reports, Brad.
That's right. Well, coming up, rent growth, that is slowing the most since the onset of the COVID pandemic. So has the peak passed? We'll discuss that next. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We've struck the top of the 10 a.m. hour here and taking a look at the major averages in the U.S. You're seeing some mixed activity right now. The Dow and the S&P 500 are in negative territory. The S&P 500 just barely. We'll see if that can get back into positive territory. Right now down just 1 point basically. The Dow, that's lower by about 0.4%. We'll round that off to. And the Nasdaq Composite, that is the lone gainer as of right now. It's up by about 0.33% here, sitting higher by about 43 points. Now over to Julie for some breaking news.
Yeah, we're looking at existing home sales for the month of April, falling by 3.4% month over month to an annual pace of 4.28 million here. So seeing some continuing weakness on the existing home sales front. I should also mention, by the way, we got the index of leading economic indicators falling by 0.6%. That was in line with economists' estimates. But the housing data has really been sort of mixed and confusing, if you will. I was just noticing on an anecdotal basis, we keep talking about how tight supply is. Yeah. But as I was driving around my town yesterday, I was seeing quite a few for sale signs. A lot of them were already under contract, though. So it seems like maybe they're still getting, I don't know, the days on the market has been lengthening a little bit. And I know it's very region specific, but I was surprised to see a new crop of those signs sort of popping up that I hadn't noticed before, for what it's worth.
Does it seem like there's a lot of traffic going into some of those open houses too then?
I don't know, it wasn't a Sunday, so I can't, that tends to be the day, right, that you get that kind of stuff. So I'm not quite sure if we're still seeing that traffic. But as we look through the data from the National Association of Realtors, and they talk about this stuff, it does seem like that things are kind of muddling along here, and we're not seeing a lot of improvement.
Yeah, and even as we're thinking about where, and you mentioned the regionality, that's going to be amazingly important to keep in context here as we move forward, because that'll give us an idea of where affordability actually still is right now. When we think about some of the major metropolitan areas and even kind of marrying that to where employment shifts have taken place too, for those who are still working from home, to Elon Musk's chagrin or not, there is a much larger consideration of where new home buyers, millennials especially, can start taking on home ownership. And for this period of time, it'll be interesting to see where some of the dust settles on a regionality basis as well, considering the shifts out of some major cities and even into from one major metropolitan area into another that might be more affordable and favorable on a price perspective. Well, joining us now for more on the state of the economy and specifically the housing sector is Jose Torres, who is the Interactive Brokers senior economist, alongside Danielle Hale, who is the realtor.com chief economist. We've been talking about retail all week. Let's talk about realty right now and real estate here. Danielle, when we consider where the market sits right now, what is a significant trend that you see emerging that could perhaps set the tone for when the housing market starts to come back in full force?
Yeah, I think if you're looking at when the housing market starts to come back, you've really got to look at affordability. So you've got a good number of people that would like to buy homes, but prices are still high and mortgage rates are still relatively high. They've come down in some recent weeks. But if you look at March mortgage rates compared to February mortgage rates, when a lot of these April home closings we're talking about would have gone under contract, they were still up about 0.25%. So, it's not huge. It's certainly not the leaps and bounds we were seeing 0.25 point a week last year, but it does mean mortgage rates are still a bit of a headwind. So I think seeing those mortgage rates come back down to below 6% is going to make a bigger difference for shoppers in the market today. I think it's also going to help on the inventory side. So we know that a lot of existing homeowners, roughly 2/3, have mortgage rates that are locked in at or below 4%. And so the narrower that gap is between market mortgage rates and the mortgage rates that people hold on their existing mortgages, the easier it is for existing homeowners to make the decision to move and trade up. But right now, the incentive just isn't there. As long as their home is a reasonably good fit for their needs, it's hard to make the case for moving.
Yeah, that definitely makes sense. Jose, how much of a headwind is this? How much is this holding back overall economic growth that we are not seeing a more robust housing market?
Well, thanks for having me. Well, real estate makes up about 20% of the economy. So when transactions go down, there's a lot of income weakness across. from realtors to durable goods manufacturers to construction companies and all of the above. And really, I think a lot of what is going to determine where the real estate market's going to go is where inflation's going and where the Fed is going. If you think that rates are going to stay, long-term rates that is, higher for longer, then it's hard to make the argument that the real estate market has already hit a bottom. I think as the consumer continues to slow, as the labor market softens, as the unemployment rate ticks up, I think the real estate market is going to soften further in the second half of this year as we descend into recession.
Jose, just to say with you for a second, what is delivering a new home getting any more easy for companies? Is there any kind of improvement in that side of the housing market?
Well, absolutely. You've had lumber prices come down significantly. You've also had supply chains improve a lot as well, and that's helped builders deliver homes. But again, the affordability situation is a particularly significant headwind, and affordability has been a headwind with a robust labor market. As the labor market begins to slow, pandemic savings begin to dwindle, I'm expecting the housing market to continue to be cool and transactions lead prices like in earlier cycles. We're seeing the same thing occur with office real estate. Transactions are down significantly, prices not that much because sellers are reluctant to want to sell into this market, but eventually they will have to. And I think the same thing is going to happen in the residential real estate market, albeit at a more tempered level because the work from home headwinds aren't there like they are for office. And residential real estate, of course, is helped a lot by that work from home trend that allows folks to have more flexibility with where they live.
Danielle, I want to turn to the rental market as well as part of all this, because I know you guys just came out with some research as well that there was single-digit growth in the rental market for the 9th month in a row after 15 straight months of declines. It looks like rental rates, median rent, up just about 0.3%. Is that portion of it sort of good news on the inflation front, that we're seeing that increase in rents moderating a little bit?
It is. So we've seen, as you mentioned, that moderation in rents for 15 months. Rents were up well above double digits, almost 20% on a year-over-year basis before then. So it's a significant cooling. And one of the main factors that's been driving inflation recently is shelter inflation. And that includes prices of rents, an estimate of owner equivalent rents that are based on market rent. So when we see rents moving up, it tends to push up inflation. Now, we've seen rents growth moderate, as I noted, for 15 months. The reason we haven't seen that picked up in inflation yet is because the government looks at transaction prices for not just transaction prices, but rents for all homeowners and renters, so people living in all housing units, whereas our data is looking at advertised rent prices. So the market is a little bit faster to adjust for those landlords with vacant units that are looking to fill them to rent. And we're seeing that adjustment slow. For a lot of renters who didn't move, say stayed in their same unit, their rents grow a bit more slowly than market rents. And so they still have some room to catch up. That's why we're seeing that inflation number continue to tick up. But we do expect we're going to see it slow. In fact, actually, in the most recent data, it dropped down just a tick from 8.2% to 8.1%. It's not a huge improvement, but I think it's the beginning of a more continued easing in that inflation measure for rentals. And that's really important for overall headline inflation.
Yeah, Danielle, as a person who stuck around New York, I don't want to catch up with the rate of growth that we have seen in rental. But, you know, if there is one thing that could help with how much people are paying for rent on a monthly basis, it could be the number of new build-outs that are set to come online as well. Is that going to kind of mitigate any concern or any of the pain or pressure that renters are paying right now?
Yeah, absolutely. So we've talked about underbuilding in the housing market, in the for sale market, but that has also been the case in the multifamily market. We just have seen a slower ramp up in response to the aftermath of the last decade. But right now, we have a record number of multifamily units under construction. It's almost as high as the peak of single family construction in the mid 2000s. So there is a significant amount of multifamily that is going to hit the market in the next year or so. And that is going to help rental units have seen a record low vacancy rates or long-term low vacancy rates up until the most recent quarter. We saw a very modest uptick above 6% for the rental vacancy rates. But until those rental vacancy rates get back closer to 7%, I think we're still going to see some pressure on the rental side of things. But with the number of multifamily units under construction likely to hit the market in the months ahead, I think we're finally going to see some easing on the vacancy pressure and the shortage pressure that has helped drive rent increases up so much.
And Jose, a broader inflation question as well, as we think about these rental rates, as we think about housing prices for that matter. How are you looking at the overall inflation picture and where we are still seeing sort of the most acute upward pressure? We heard, for example, from Walmart today saying it is still seeing input cost inflation. So how are you thinking about the big picture here?
Well, I think services are the primary driver, and that tends to be particularly sticky. Wages are also rising at a pace that is totally inconsistent with the Fed's 2% inflation target. And like Danielle said earlier, shelter is also cooling, but is it cooling down to a 2% inflation level? And the answer is no. While rents nationally are cooling, rents in some areas of the country, like in New York City, are at record highs. So I think taken together, services continue to be the primary threat on the inflationary front, and services are also working itself through expectations. We saw earlier in the University of Michigan's Consumer Sentiment Survey, expected inflation over the long term ticked up pretty dramatically, and that is affecting consumer behavior, that is affecting employer behavior, that is affecting landlord behavior, and it all looks like we're entering into a new regime of 4% inflation. And if the Fed is serious, and I think they are, with Powell at the helm, about getting to that 2% target, then further monetary policy restraint is warranted. And under those conditions, I think that unfortunately, we're going to have a little bit of a soft patch in the second half of this year.
Well, we will be watching all of that on the housing market and in the broader economy. Danielle Hale, Realtor.com chief economist, and Jose Torres, Interactive Broker senior economist. Thanks to you both. Great perspective on the housing market and beyond here. Well, the debt ceiling debate continues in Washington as the deadline to avoid default looms. But the back and forth might be a good thing for someone far away from here, China. Yahoo Finance's Rick Newman joined us now with the details. What does this have to talk to us about the feed through here, Rick?
This is some analysis from the Peterson Institute for International Economics. Everybody's trying to figure out the second and third order consequences if there were to be some sort of default, even a short-term technical one. And one of them is that it could enhance the standing of China's currency. There are a lot of countries in the world, believe it or not, that don't love the fact that the U.S. dollar is the world's reserve currency, and they would like to be able to do more business, more trade in local currencies. So they're, and this includes China. I mean, China really would love if more transactions, especially in their part of the world, in Asia, were conducted in the RMB, the Chinese currency. So if we would have something like a default, it's not like investors all over the world would just simply dump the dollar and dollar-denominated securities, but it could create an erosion effect. I mean, let's remember, the U.S. has never really defaulted before. Nobody knows exactly what will happen. But as economists and analysts try to think through, what could some of these consequences be? One of them is declining confidence in the U.S. dollar and the declining use of the dollar as the world's reserve currency.
Sort of more immediately, Rick, I do wonder what the president's decision to not go visit Australia and Papua New Guinea, because that at least was aimed in part at solidifying sort of a China alternative, right? Or
right.
An axis against China, if you will, in the Pacific. Do you think that's going to also have some lasting effects, or is that one sort of repairable?
Well, I mean, the reason he did that is because he feels like he has to come back home.
Right.
To deal with the debt ceiling problem. So it all, the debt ceiling controls everything. The tail is wagging the dog here. I think Biden can make that trip at a different point. And he kind of split the difference on this. He could have canceled the whole trip, and he didn't do that. He's in Japan right now. So that's an important part of the trip. He's also talking about trying to keep support going for Ukraine in its war with Russia. I think Biden, he's in the second half of his first term. That's a time when a president loves to focus a little bit less on domestic politics, especially now that Republicans control the House, fly around the world, be a statesman. Biden is trying to do some of that, and he would like to do more, but he is being yanked back because of this stupid showdown over the debt ceiling.
Yeah, well, we'll see how it plays out. Rick, thank you. Appreciate it.
Bye, guys.
And let's take a look at a trending ticker that we're watching today. The Goose is cooked. Canada Goose falling after forecasting. No offense against Kenley. I can't resist the little wordplay sometimes. Shares are down 6%. Annual sales were forecast above estimates as sales in China bouncing back, but the retailer also saw losses narrow in the fourth quarter, boosted by growth in the Middle East and Europe. I know you were looking at this one, Brad. Why is it down so much? Do we know?
Well, they highlighted a few things in the earnings report, and it seems like the investors might be caught up on this broader long-term plan that they've got. It had about 3 or 4 pillars as a part of it, and particularly for Canada Goose, I think it has really been able to push itself towards a more affluent consumer, higher end of the purchasing market as well. And if you did start to see some weakness within that part of the consumer, which has showed up a little bit beginning to in the consumer confidence numbers as well, then that could impact a company like Canada Goose.
The shares were higher earlier.
The shares were higher earlier, which is what makes this interesting in this move. But just part of that kind of like 3-pronged plan that they had put forward here. One, accelerating consumer-focused growth. They're also looking at building out a direct-to-consumer network, which I was pretty sure they already had, because that's the only way that I've gotten a Canada Goose jacket in the past. And then they're also going to be investing into some new categories as well. And perhaps investors looking across that investment and trying to get a picture of what that spending into DTC, what that spending into the new categories could look like in trying to ramp that up.
You know, I always like to look at short interest, and this one has high short interest. 27% of float is shorted for Canada Goose. So a lot of people had been betting that the stock would go down, and now it is going up. Coming up next, the Wall Street Journal's Ben Eisen enjoyed the musical interlude at one of this week's Senate banking hearings. We'll explain it all and the serious business of bank failures next.
Your lack of judgment, Mr. Becker, shows that you should not have been running the bank.
There are CEOs and banks all across this country that are having to pay up for your mistake.
And the taxpayers of America had to pick up the tab for your stupidity, didn't they?
It sounds a lot like the dog ate my homework.
Your opinion on what is a responsibly managed bank is now laughable.
This was bone deep, down to the marrow, stupid.
The public flogging. Harsh words from a number of senators grilling regional bank executives over their role in the demise of their institutions. 4 banks have now failed this year. Executives from Silicon Valley Bank, Signature Bank, First Republic, they all sat for hearings in the Senate and House over the last couple of days. Let's talk about it all with Wall Street Journal reporter Ben Eisen. Ben, we didn't even get into the video that you detailed they played. There was an actual Signature Bank video where they joked about how hard it was to start a bank and that, maybe it would go bust, and it did end up going bust. I mean, but joking aside, what is going to come of this besides that sort of public scolding, right, that these bank executives got?
Well, this has been, you're right, there was one somewhat comical interlude there with a video produced by Silvergate Bank, or Signature Bank, that is, before their failure. But besides that, it was a pretty serious hearing, and there was a lot of public scolding, as you said. The senators and Congress people who brought in these executives, they really wanted to kind of publicly shame them. And this was really the first instance where these executives have appeared publicly, and they presented sort of their own version of what happened. And, for what we've heard from the most part so far is that this was a case of bad management. And so now we're hearing from the managers, and they say, you know what, it wasn't a case of bad management. It was a case of a deposit run that proved kind of uncontrollable. And it is definitely an alternate version of events. It wasn't one that kind of landed particularly well with Congress. So we'll see sort of what happens in terms of whether they'll face any more sort of public repercussions of all of this. But for now, we're just sort of kind of trying to make sense of how their version of events fits with what everybody else is seeing.
And Ben, the bank executives all had one thing in common in their testimony. They tended to blame the bank that failed before their institution did. Take a listen to this.
Despite stark differences in our business models, news reports and investors wrongly lumped SVB and Silvergate together.
The bank with strong ties to the digital asset sector announced it was going out of business, and a second bank was closed by the regulators. And then within just a few hours, our depositors withdrew $16 billion from the bank.
No one at First Republic could have predicted the collapse of Silicon Valley and Signature.
And so, as my mother or family member would say, when all of my siblings were trying to play the blame game, somebody lying. Who, at the end of the day, is actually telling the most accurate depiction of what happened here, Ben?
It's an interesting question, and the first bank to fail, conveniently, their executive was not there. That was Silvergate Bank. So everyone could blame Silvergate Bank as the first one, and there was no one to speak on their behalf. That said, this was sort of a version of events that it kind of raises an interesting question, right? These banks failed because there were deposit runs. You can't really deny that. There were deposit runs that made it kind of unsustainable for these banks to continue operating. Now, what caused the deposit runs? That's a question that everyone's trying to get to the bottom of. And in these hearings, for the first time, you saw these kind of two fundamentally different views of what happened. What caused the deposit runs? Well, Congress people said this was bad management. The bank's executives put the bank in a kind of place where they were susceptible to a deposit run. Now, the executives say this was not something that they could have predicted. Once something like this takes hold, it sort of just kind of contaminates, as the First Republic executive said. It just kind of spreads and kind of takes a life unto itself. And it was all sort of hyped up by social media and all the sort of various things that made this go quicker than it had ever gone before. So, there is sort of an element of truth to that, whether or not, the bank was sort of already, these banks were already in sort of these bad positions where they were susceptible to all of this. That is sort of a question that was a little bit kind of dodged by these executives.
Right. And when we talk about the issue of accountability, Ben, the former CEO of Silicon Valley Bank got a number of questions about his pay because the senators did not seem convinced that these guys were not necessarily culpable. Senator Elizabeth Warren in particular has introduced a bill that would give the FDIC authority to take back pay over these bank failures. And Warren had a particularly striking back and forth with Greg Becker about his $40 million pay. Let's listen to that.
How much of the $40 million are you planning to return? How many times are we going to do this dance?
Senator, I promise to cooperate with the regulators as they do.
Are you planning to return a single nickel to what you cost the fund?
Senator, I know there's going to be a process review of compensation.
I'll take that as a no.
So basically he's saying, I'll give it back if they're going to make me give it back. Are they going to make him give it back? What are the chances of that legislation getting through to do some of these clawbacks?
Yeah, so Elizabeth Warren's line of questioning was sort of one that I would say, pretty much every congressperson asked in some form or another over those 2 days, which was some version of, did you deserve this compensation? Why did you get this compensation? What's going to happen with it? And Greg Becker pretty much answered the same way every time. If regulators make me give it back, I'll give it back. And so, it seems kind of on a bipartisan level, everyone sort of agreed on the congressional side that he did not deserve the compensation in the year before his bank failed. Whether that leads to actual legislation, it's hard to say. But there is definitely this sort of scorn around compensation was definitely a constant thread throughout all of this.
If they didn't already know, is there anything that the American public can take away from a hearing like this and identify a mismanaged bank even?
It's hard to say. One of the representatives yesterday kind of spoke to these three executives and said these were the three worst managed banks in the country. So these three are certainly being called out in a way that suggests they were kind of worse than the rest of the banking industry. You had these three banks fail. You had Signature before that, or Silvergate before that, excuse me. And you still have this kind of this sense of this is unsettled, that the banking industry is unsettled at the moment. But we really haven't seen any banks kind of get to the precipice since these three banks. So there is kind of an effort, even during these hearings, you saw this kind of distinguishing going on between these three banks and the rest of the industry, where perhaps there's a bit more strength.
Yeah, Ben Eisen, great to catch up with you. Interesting commentary on all of the goings on there. I appreciate your time this morning.
Thanks for having me.
Let's do a quick check of the markets now, sponsored by Flex Shares. We see a mixed picture here. The Nasdaq gaining by 0.75%. The Dow little change, though, slightly to the downside as we get in about an hour into the session.
Coming up, are you in the market for Tesla's Cybertruck? Julie Hyman has her name on the list. Apparently, it will hit the market this year. We take the pulse of the EV landscape next. The EV race is filling up as new players from every direction join in on the action. However, with more options comes fierce competition to win the hearts of consumers. Here with the latest pulse on the auto landscape, we've got Alex Wellen, who is the Motor Trend Group CEO and President, along with Yahoo Finance's Pras Subramanian. Alex, great to have you here on set with us.
Thanks for having me.
Absolutely. Okay, so we've been having so much spirited discussion about EVs at a whole, and still the part of the broader automotive purchasing that they account for right now. What are some of the trends that you're seeing among consumers and how they are gravitating towards some of these vehicles, and perhaps when we could see more dominance of EVs on the road?
Yeah, I mean, the percentages changed so significantly in just the last year and a half too, and the availability and all the different types of cars. I think, we do independent research as well too, and 78% of the people who are in the marketplace right now are very interested, right? Very interested in getting into an EV. And then within the next 5 years, we predict that about 50% will definitely or very likely be inside an EV. All of us, all the people who are watching right now are saying to themselves, all right, I know I'm going to get an EV. Is it the right time? I don't know about the range anxiety. I don't know about, how I'm going to charge it. Is it affordable? But everyone knows that they're going to be inside of an EV soon.
Looking at some of the data you guys publish, and the usual suspects are up there in terms of the top search models, right? Tesla Model 3, the Ford Mustang Mach-E, et cetera. But recently you guys said the Rivian is the most popular EV searched overall on Motor Trend. You guys do a lot of, have that car shopping tool. What do you think is going on there?
Well, Rivian was our truck of the year last year. Lightning, Ford F-150, another truck, another EV, is our winner this year. So the trucks are extraordinary, and the Rivian, which I've driven, and the Lightning, which I know you've driven as well too, and then we'll talk about the Cybertruck, which I've been in as well, which is an experience. But the Rivian is extraordinary. I mean, it's 4 motors, right? Many of these trucks are 1 or 2 motors, right, to be able to do what they need to do that workload and how much battery you need. But 4 motors, you feel it immediately. I think they've done a great job with the regenerative brake. So that's that feeling of being able to really one pedal a car. I'm so used to 3 pedals, with a manual. I don't know if any of you have driven manual, but now you're down to 1 pedal.
This guy has.
Yeah, you can go from end to end and never touch the brake. And the Rivian is really extraordinary. I think the design I don't know how about you, but every time I see the design, I think it's pretty incredible.
So let's talk about the design of the other one that you mentioned.
The other one.
And viewers will know I am skeptical about the Cybertruck. And when you look at the audience that wants a Rivian or a Ford F-150 or a non-electric pickup truck for that matter, is that the audience for this thing? It doesn't feel to me like it would be.
Well, people have counted Tesla out many, many times before, and they keep coming back with these interesting and affordable types of vehicles.
Is that an attractive car? Tell me, Alex.
Yes. I think in a dystopian world where, the road warrior is behind you, I think you'll need that truck.
Is that the world we live in?
On wheels.
I like it. I'm sure I'll get a lot of hate mail for that, but I love it. I think, I agree with you. I think from a design point of view, it's very polarizing, and I think a lot of people just won't simply want it. They want to do the work. The Ford 150, whether it's a Lightning, an electric or not, is the #1 selling automobile, period, for a decade, right? So I don't think they're going to lose that market share, but I think the Cybertruck, Musk has done a nice job of surprising us. He said it would have 3 motors, and Rivian comes along with 4 motors. I'm sure they'll have 4 motors. And that truck is a lightning rod, but I think they will do well with it. They're doing extremely well with the semi-trucks, right? So I would never count Musk out in that way. But I agree, maybe it doesn't suit you. Maybe, are you more of a Ford F-150 or?
No, I'm none of the above, but I'm just
Are you an electric person?
I'm a hybrid person right now. What about the fact that it's not all-wheel drive? Is that a problem?
I think that when you have 3 motors, then you're going to be equipped to be able to get wherever you need to do. And you saw what it did with the Ford 150. I think, I'm sure Ford would disagree with that test that was done in 2019. And I was there when they showed us it. I went inside the Cybertruck, and it was extraordinary even back then. But I do think they have a ways to go, and I think the pricing is something that they're not going to necessarily be able to honor.
What price do you think it needs to come in at?
Well, I'm the wrong person to ask because I have my staff who's much smarter than me on these type of things. I mean, I think.
What do they say?
Well, when we talk about it, we say yes, there's this beautiful $40,000 truck idea that nobody can actually achieve, because your Ford F-150s, your Rams, all these trucks are really going to have to be $50,000 to $60,000 to get into it, and you could spend up to $100,000. They said, Musk said in 2019, 3.5 years ago, that it would be $39,000. I think eventually, like they did with the Model 3, they'll have a $39,000 truck, but initially, if they want to do 3 or 4 motors, I would say they would be lucky at $75,000. I think you'll probably be in that range. And the way they'll say it is, hey, I know we talked about that $39,000 truck. It's coming, but if you want the fully loaded 4 motors, it's going to cost you $80,000. That's my guess.
So Alex, it's kind of taking a step back with Motor Trend. You know, it's a TV station now. It's not only the magazine, but also the website and the car buying tool. You're in town for upfronts right now. What's sort of the media landscape kind of like general feeling right now? And is it about being niche? Is it about having like a really kind of focused product?
So Motor Trend people know of the year, and they know our magazine that goes back 75 years. We're celebrating 75 years. But we're the largest media organization in the world for automotive. So we have a TV network, a cable network that's fully distributed. We have direct-to-consumer that has about 7,000 episodes. We have a studio that does hundreds of hours of original content, and we have FAST, which is the free ad-supporting services. But then on the other side, in addition to live events that we do and social, we have all these tools, these research tools and these bias guide tools and this research that we're doing to help put people inside of cars. As far as the landscape's concerned, I think, right, it's always a question in business about how wide do you go and how deep do you go. I think for someone like us, I think there will be this moment coming where going deep is really important for fans, right? So all you can eat is really critical if you have great brands like Warner Brothers Discovery, like these extraordinary brands like DC and Harry Potter. But for someone like us, like Motor Trend, and we own Hot Rod and Super Street and all these other brands, we want to go deeper. Like if I were to ask the 3 of you, what are the 2 or 3 cars that define you, like that your parents had, that you had first of all, that you saw in a film? Like I would know so much about you. You would have an instant connection. I feel like that's what we need to do with our fans. Understand the cars that matter most to them. And so, yeah, I think the more we can do to help get them in the car and be generous, the more we can do to celebrate car culture, even if it's electric, I think is awesome.
Just really quickly, you guys still have a print magazine.
We do.
How?
Because, well, first off, it should be profitable, which is a good business transaction, which it is for us. And we used to have dozens of magazines. We have Motor Trend and Hot Rod right now, too. So I think those magazines are critical for the brand from a marketing point of view, too. They should be profitable as well. And the quality should be there too, because so much of our audience really wants that kind of visceral connection to it. So we are looking at different ways that we want to publish a magazine and how it looks, but I think people, cars are very visceral, and so magazines are very visceral too. So in that regard, we think it's important to have in the portfolio, because we could put them on the cover, and we can have them on TV, and we can do a lot of different things.
Tactile. Alex,
yes.
Thank you so much. This was really fun. Alex Wellen, Motor Trend Group CEO and President, and our Subramanian, of course, as well. Coming up, TikTok has its first ban in the United States. Where is it? What comes next? We'll discuss the future for the ByteDance-owned app. The TikTok crackdown is escalating. Montana has become the first state in the U.S. to announce a complete ban on the social media app. It's due to take effect on January 1st, 2024. Yahoo Finance's Dan Halley joined us with the details. Dan, I'm sure we've talked about this before, but refresh my memory. How does that work, first of all? Like, what is the mechanism for banning an app in a state?
That's a great question, and I don't think a lot of people have the answer to that exactly. The only thing that you can imagine would be that they would geofence, basically, electronically lock off Montana from the rest of the country, and then that would allow for the app to basically be kind of persona non grata there. That would mean that Apple, the App Store, and Google, the Play Store, would no longer allow the app to be downloaded. And that's really the mechanism that Montana Governor Greg Gianforte is going for here, basically stopping both Apple and Google from allowing users to download the app itself. Now, in a statement after signing this into law, the governor said, "Today, Montana takes the most decisive action of any state to protect Montanans' private data and sensitive personal information from being harvested by the Chinese Communist Party." So there's a few things here that are worth discussing outside of the broader geopolitical issue. And that's when you speak to a lot of privacy advocates regarding TikTok, the issue is, sure, there could be a problem where China could eventually harvest the data. TikTok itself is kind of working, or TikTok in the U.S. is working with Oracle to get user data for U.S. users onto Oracle servers in the U.S. rather than anywhere else in the world. So that would be located here. They say that it wouldn't have access, or China wouldn't have access to it, and that there would be code reviews, everything along those lines. I think the broader discussion that privacy advocates point to is that, sure, the issue of China is there. The real problem, though, is user data privacy. And that's something that we frankly don't have in the U.S. There are some states that have enacted their own data privacy laws, but there's no federal data privacy law. And that's the bigger problem. TikTok wouldn't be able to get user data if there was a federal law in place that could allow users to opt out of data collection. This is something that's been brought up for years. And so, I've previously written about how TikTok is as dangerous as any other social media app out there, whether that's Facebook, Instagram, Twitter, YouTube. They all collect user data, and they're all available to third parties who can then use that data to create some form of profile to kind of get a good idea of who you really are as a person, and just, give you the scope of what these companies are able to do. People often think that their phone is listening to them or something along those lines because they thought of something, or maybe they talked to their friends about something. Say you were talking about used cars, you're getting ads for used cars. I didn't search for it on my phone, it must be listening. That's not true. The truth is that ad networks are so good at predicting who you are as a person that they already know that you were talking or would eventually start thinking about used cars, and they served you up those ads before you even thought about looking for them. So that's the big problem, is that user data privacy in America really doesn't exist on a federal level, and that needs to be enacted rather than a wholesale ban on TikTok. At least that's what the privacy advocates say.
I sure wish you could tell me when I'm going to buy a house, Dan. Appreciate that. Thanks so much for the update on all things TikTok and the ways that certain platforms are already getting some of this data to create a profile. Appreciate it. Okay, guys, coming up, restaurants remain surprisingly resilient in the face of economic uncertainty. Deeper insight into how consumers are spending from e-commerce platform Lightspeed's earnings coming up next.
Lightspeed Commerce came in line with expected revenue and narrowed losses in the fiscal fourth quarter. The company's point of sale and commerce platforms cater to retailers, restaurants, and golf courses across more than 150,000 locations. Weaker customer spending conditions over the past few months did hit the company's users, particularly retailers, but Lightspeed did see stronger growth across its hospitality businesses as customers continue to dine out and travel. Notably, the company's adjusted EBITDA loss in the quarter came in significantly better than predicted, and Lightspeed is hoping to break even in the new fiscal year, even with the cautious outlook in the near term. That cautious near-term outlook does seem to be putting some pressure on the shares, though. Lightspeed CEO JP Chauvet joins us now. Good to see you, JP. So it does seem like the near-term outlook is hitting the shares a little bit, but talk to us about what your customers are seeing and therefore what you're seeing right now. Give us sort of a snapshot.
Yes, thanks for having me. Good morning. So look, generally speaking, you said it correctly. We are seeing the hospitality space really do well. And as you know, we work with the more established restaurants, a lot of Michelin star restaurants. And here we're seeing a lot of demand. We're seeing high growth in the GMV across the globe, in the US and in Europe and in Asia. The flip side of that is the retail side of Lightspeed. We're seeing basically slow growth year over year, and we understand a lot of the pressure points from the markets. And we're seeing that all the industries that were doing well during COVID, outdoors, sports, and home improvement, have not been doing well. That they're declining pretty strongly year over year. So for us, we're very cautious with the outlook, but we're very happy with the quarter, and we are being very cautious when we look at forecasting next year.
Bank CEOs this earnings season have said that the consumer right now is healthy. You're able to track transactions across both the retail, the restaurant experience, even the kind of experience economy, if you will. With all that considered, how would you describe the state of the consumer right now?
We're seeing a very strong demand for luxury goods. We're seeing very strong demand for apparel, jewelry, and especially a strong demand for anything related to experimental hospitality. So Michelin star restaurants or fine dine restaurants, we're seeing a ton of demand everywhere. So it's interesting to watch, but the consumers seem to be still going out and shopping for luxury goods and dining in fancy restaurants. So we haven't seen any slowdown. Actually, GMV has been growing really well year over year.
Gross merchandise volume, for those who don't know the acronym. JP, you guys talked in your statement about sort of streamlining your offerings. Can you explain that to us a little bit more, the changes that you guys have made and what that is meaning for the business?
Yeah, so what we're saying now, it's called unified payments. That's the strategy. Is we're saying we want all of our customers to use not only our software to manage everything inside of their restaurants and retail stores, but we also want them to use our payments platform. And the reason why we're doing this is no matter how hard you work on making an incredible product for your back office, the majority of our customers have very outdated payment terminals. So we're doing everything we can to ensure that we're bringing them into Lightspeed, also all the way to the transaction with their end customers. So that means we're going to be giving away a lot of terminals in the first half of the year. We're going to be doing everything we can to accommodate rates, to get all of our customers onto unified payments, because that means in the second half of the year, we're going to see very strong growth and we'll be a profitable company. So that's the last step, if you will, of the One Lightspeed project and our path to profitability is what we're doing now in the first half of the year.
So you talk about that an EBITDA break even for the full year, right? So when does that? Yes. Then does that from this year on sort of become more consistent profitability?
Absolutely. And we've always said that, you need to scale, and as you scale, you reach profitability. That's the story of all, software and SaaS companies. But here for us, what we're going to be doing in the first half of the year is really getting our entire customer base to move to Lightspeed Payments. And for us, it's really important because a customer on payments is twice the same net rate or the twice the profitability of a customer if they use payments. So that's why the first half of the year is going to be kind of slower in terms of growth because we're focusing on bringing our customers onto payments. But then that means that on the tail end of the year, we'll be ending the year close to the rule of 40, high growth, and with a very strong sales efficiency, if you will.
JP, want to talk about a specific part of your business because I am kind of a golf fan as well as enjoy playing the sport. And I know that that is a part of your business that you would look to see kind of more growth during times of kind of consumer discretionary dollars, whether that be on a product or service side, that gets pulled back. It typically is the golf spending. It's an expensive sport. Have you seen any moderation in the type of and the amount of transactions that are taking place across golf courses and the network that you currently have of customers right now in that part of the business?
So surprisingly enough, we haven't, and that's why we've seen actually strong demand. So, we work with a lot of great golf courses, St. Andrews being a good example, or Sandals, in the Caribbean. But we haven't seen any slowdown. We're actually seeing stronger adoption right now in the golf space. We're seeing strong demand, and I think that was an industry that was really underserved in terms of technology. And we're seeing a lot of demand for our platforms and no slowdown in terms of tee times. We're seeing quite the opposite. The golf business for us is doing really well.
Awesome. St. Andrews is one of my favorite shirts. My dad got me 1 year out there. Thanks so much. Lightspeed CEO JP Chauvet. Let's do a quick check of the markets here as we're taking close to the end of the hour here. Sponsored by Flex Shares. All major averages are in positive territory. The Dow, the S&P 500, and the Nasdaq seeing green. The largest percentage basis gain we're seeing right now is the Nasdaq to the tune of about 0.9%.
And we have some other more sad news this morning. Billionaire investor Sam Zell has died at the age of 81. He was known by many as a pioneer in the real estate investment market. Equity Residential, the apartment company he founded, called him an iconic figure who helped democratize the ownership of publicly traded real estate. He famously called himself the grave dancer for his bets on distressed assets, not all of which worked out, by the way. His purchase of the Tribune company, the media conglomerate, did not turn out well. It went into bankruptcy. But I had the opportunity to talk to Sam Zell in a couple of instances. Just a really interesting guy, gruff, sort of small in appearance, short in appearance. He was someone who fled the Holocaust, but just a really interesting character. I encourage everyone. There was this great profile of him from the mid-2000s in the New Yorker that really talked about his toughness and where he had come from. It was really fascinating.
Really interesting. Well, we do send the heartfelt just our condolences out to his family as well as the team that worked with him over at Equity Residential as they mourn the death of founder and chairman Samuel Zell.
Diane King Hall stepping in today for Rochelle Cupo. She's got you for the next hour of trading. Keep it right here.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Diane King Hall. Here's what I'm watching. Walmart pushes past the economic doom and gloom as it lifts full-year guidance, but there's more evidence of a very selective consumer. We'll talk retail this hour. Facing the fire, senators have grilled former bank execs over their recent failures. What would former FDIC Chair Bill IXIC have done differently? We'll ask him. And the legal battle over abortion medication mifepristone lands at a federal appeals court. We go through the latest on a highly emotive issue. But first, let's take a look at the major indexes. Let's see where Wall Street is trading in the early action. You've got a little bit of an advance there, small gains more in the tech sector with the Nasdaq on the plus side of nearly 8%, so leading the pack there. S&P 500 and Dow, slim gains as investors start to gain hope again about progress on debt ceiling negotiations. Let's do a quick check on the Treasury market as well. We'll take a look at the 10-year, 5-year, all posting gains. You got up 5 basis points on the 10-year, 7 on the 5-year, and over on the 30-year yield, you got 3 basis points higher. Let's get right into a retail roundup. We've been on retail detail all week long. You've got Walmart in focus today, out with its quarterly report card. You're seeing shares higher by about 2%. The retailer beating on both the top and bottom line, raising its full year forecast. We saw strength in grocery, significant strength in grocery and its e-commerce business. Overall, a solid showing for Walmart. The story was a little different over at Target yesterday. Same-store sales almost flatlined in Q1, while digital sales slumped 3.4% from a year ago. Target saw a big issue with in-store theft. CEO Brian Cornell said that could trim profits this year by $500 million. Overall, there's a pattern emerging that consumers are being more selective in their purchases, avoiding bigger ticket items. Even Walmart talked about that. And we saw that at Home Depot, which came out with a brutal earnings report on Tuesday. The retailer out with a big warning on sales after its biggest revenue miss in over 20 years. That report showing consumers are backing off of those big projects that we saw during the pandemic and spending less on things like patios and grills. They don't need them anymore. Right, Brad?
Well, yeah.
Yes, and we spoke to Walmart CFO John David Rainey earlier, and he said shifting consumer spending is having an impact on business. Let's take a listen to that.
We continue to see, as you noted, a mix shift in our business. As consumer wallets are stretched more thinly, they're shifting more of their dollars to purchasing items like food and consumables and less away from general merchandise. And overall, that does have an impact on our business because general merchandise tends to be higher margin for us. But even despite that, we were able to grow operating income in the quarter 17% and increased our guidance for the year as well.
Shares of Walmart, again, take a look at that. They are trading on the plus side after those strong first quarter earnings. We'll talk about all of this in the retail sector that we're seeing. And we've done this before where we look at different companies and sectors reporting, and we have that tale of two cities kind of scenario where you have a Walmart versus, say, a Target.
Yeah, so holistically here, we've had a lot of the retail companies reporting over the course of this week. Give us a picture of where consumers are continuing to spend and where they are not. And if you're listening to even the comments from CFO of Walmart, John David Rainey, who spoke with us here on Yahoo Finance, one of the things that he leaned into actually was in the top line of their report here, and particularly on the first bullet item that they laid out, saying that they saw gross margin rate decline by about 18 basis points, and that was on a mix of sales. That is something that you've heard from the likes of Target even. And so even as they're signaling the same thing, the results are coming in different, and it's because of some of the other categories here. Now let's remember, Walmart is one of the stalwarts of grocery. And as long as they're able to continue to have that engagement with customers, get them in the store for groceries at large scale. This is a company that going into the pandemic had about 25% of the U.S. grocery market. And so now, compounding years later on what they've been able to do with that, investing further into their digital and buy online, pick up in store, or pick up and not even go in store in some cases, at the end of the day, Walmart has created significant touch points both in the digital and the in-store capacity for themselves, to the point where on the digital side, they were able to see e-commerce up by about 27%. And what did they say that was led by? Pickup and delivery. That brought their U.S. comp sales growth up 7.4% here as well. So all in for Walmart, it's a larger question of now going forward, even as we were listening to the commentary from the conference board in the Consumer Confidence Index just weeks ago. Consumers did become more pessimistic during the month of April about the outlook for business conditions and labor markets. But when it comes back to their spending and how they are going to continue to look across those markets and what they're hearing on the R-word recession, that really perhaps curtails some of their discretionary spending. For companies like Walmart, they're hoping to play up, at least in their mix shifts, where those necessities still play a major role in that customer relationship.
And again, it was clear that grocery was key in those numbers, with grocery accounting for 60% of sales. You know, so it was clear that consumers, they have picked a major sector to play in, and consumers are being very cautious with their dollars, and Walmart is the beneficiary of that, of necessities. You know, but Walmart did notice that consumers were more choosy about size. So like packaging size, and also not necessarily picking a name brand. But for more analysis on Walmart and its latest quarterly report, we want to bring in Michael Baker, who is D.A. Davidson Managing Director and Senior Research Analyst, for some analysis of both Walmart's numbers and the broader retail sector. So Michael, what's your top takeaway first from Walmart's latest quarterly report?
Well, I guess it'd be twofold. One, there's definitely something going on with the consumer, i.e. a little bit of caution, a little bit of slowing sales. We've seen this, as you said, in all the guys who reported this week, as well as other data points, including the retail sales numbers that came out on Tuesday. We're definitely seeing a slowdown. On the other hand, as it relates to Walmart in particular, they're just really well positioned in this environment. They're 7.4% U.S. comp, excluding gases, ahead of expectations. A strong number. We think will be one of the stronger ones that we'll see this earnings season, and that's because of their positioning as a low-cost provider for everyday basic needs.
So, Michael, you call Walmart an economic bellwether. It clearly is. What do Walmart's results say to you about the state of the consumer?
Focused on needs rather than wants, and again, that's why Walmart is so well positioned here. We're seeing it even from higher-end customers trading down into the Walmart ecosystem, and the focus on grocery, which was up low double digits. Health and wellness, a really strong category. In fact, their best category. On the other hand, general merchandise, which is tends to be more wants versus needs, was down in the quarter. So the U.S. consumer is spending, but they're just spending more on things that they need rather than what they want.
And let's talk about Target. Target cited a big issue that they're having, similar to some other retailers, about shrinkage, and particularly just the impact of organized crime. What's your thought on what's happening with Target and what it will mean for its profit?
Yeah, well, so they're not the first ones to call this out. Home Depot, in fact, called it out a couple years ago, and we're seeing it across retail. What Target said specifically yesterday is it'll cost them $500 million more than they thought it would cost them. So that's an incremental about 0.5% to sales. And by the way, that's above and beyond the increase that they saw last year. So it is an issue. It's definitely not Target specific. I think what's happening here is Target is just taking the leadership role and calling it out, emphasizing it. It's getting a lot of airplay on your network and others. And I think the idea is that they need policymakers to take a look at this and maybe help out a little bit. So it's definitely an issue at Target. I think it's an issue everywhere. I don't think it's a Target specific, or even worse at Target than other places. Again, they're just taking the lead to try to highlight it, in my opinion.
Okay, so that's a different issue than you see in terms of the breadth and scope of how this is impacting some retailers. Are there some economic headwinds that you're paying attention to when it comes to the impact it can have on these retailers?
Well, what we're seeing in the economy, I think, is a little bit less confidence because of inflation, because of the unemployment rate still is actually very low, but we're seeing a little bit of slowdown in hiring. People are seeing that on the news, and they become a little bit less confident. and they want to spend a little bit less. And so that's, pretty much what we're seeing in the results from these retailers, as well as some of the economic data, like the retail sales data. Now, I will say the situation, I think, was exacerbated a little bit in the last few months from the lower tax refund data, which really hurt sales in March and April. And that's a real issue. I suppose if there's some good news, that should become less of a headwind going ahead. That's more of a first quarter and spring issue. Also, the weather was actually pretty unfavorable in March and April as well. Very cool, wet spring. So there is some hope that things will get better later in the year, but still that's within the overall context of slower sales after what had been, a couple of record years in 2020 and 2021. And even 2022 ended up being a pretty strong year.
All right, Michael Baker, we will have to put a pin in our conversation, although I could talk retail all day long. We appreciate you joining us as usual. Thank you. All right, a trending ticker we are following is Alibaba. That stock right now under some pressure, down nearly 4%, 3.8 to be exact. Alibaba getting dinged after missing revenue expectations following its latest quarterly report card. The company logged revenue of what translates to about $30 billion in US dollars. Well, that was an increase. It was weaker than expected. Now, keep in mind, this quarter is the first full quarter in nearly 3 years that accounts for a full reopening of China. China still had strict COVID controls through the end of last year. Alibaba also revealed plans to spin off its cloud division next year, not helping the stock. Meantime, coming up, facing the fire, senators have been grilling former bank executives over their recent failures. What would former FDIC Chair Bill IXIC have done differently? We'll ask him. That's next. All right, let's do another quick check of the markets sponsored by Flex Shares. Let's take a look at where the major averages are. Right now you have the Dow a little flat. It's been flip-flopping. The S&P 500 and Nasdaq still holding on to a gain. Once again, Nasdaq tech sector leader of the pack today. Investors kind of cautiously optimistic about debt ceiling talks that are happening this week. Now, lawmakers in Washington this morning are currently holding a hearing diving into crypto regulation. In focus, payment stablecoins. Joining us now with the latest from Washington is Yahoo Finance's own Jennifer Schonberger. Jennifer?
Good morning, Diane. Republicans and Democrats on the House Financial Services Committee remain at odds on how to regulate stablecoins. In an ongoing hearing before a House subcommittee on digital assets this morning, divisions still remain between both parties, though sides may be inching closer.
While there's still work to be done, and we should use today's hearing to discuss those key areas, I want to emphasize that the similarities between the two proposals are strong, and that's why we're not that far apart.
It appears that we've shifted further apart from a bipartisan agreement and now considering two different pieces of proposed legislation.
Democrats acknowledge that Republicans have attempted to address some of their issues, such as banning non-bank stablecoin issuers access to master accounts at the Federal Reserve, as well as the central bank's discount window. But there are still outstanding issues between both sides on the role of state and federal regulators. Republicans' draft bill would give strong authority to states to continue regulating stablecoin issuers. Subcommittee ranking member Stephen Lynch said he has concerns about giving sole authority to states because it risks the possibility of crypto companies seeking out jurisdictions with the weakest regulation. Representative Maxine Waters, the top Democrat on the full House Financial Services Committee, is concerned the Republican bill doesn't have oversight of digital wallets. Her draft bill would strengthen protection for digital wallets when it comes to separating customer assets from crypto exchanges, that so-called commingling, a major issue with the collapse of FTX. Her bill would also strike direct access to the Fed for non-bank stablecoin issuers. Now, this hearing coming after Republicans surprised Democrats earlier this year by proposing their own draft bill to regulate stablecoins, causing Maxine Waters to basically say that sides now have to start from scratch. This is the second hearing we've heard so far this spring on stablecoins. Republicans taking a very conciliatory tone towards Democrats, though there are still divisions there. Back to you.
All right, Jen, thank you so much. Well, Senate Banking Committee members are currently hearing testimony from financial regulators to closer examine their role in the banking crisis that saw 3 major banks collapse earlier this year. Among those testifying is FDIC Chair Martin Gruenberg. Now, earlier this week, the committee grilled a former Silicon Valley Bank CEO and Signature Bank execs. You're looking at Senator Elizabeth Warren over there grilling over mismanagement that lawmakers say led to the bank's failure. Bill IXIC served as FDIC chair from 1981 through 1985. He joins us now with his thoughts. Bill? Thank you so much for joining us. Good morning. All right, let's get right into this week. They've been in the hot seat this week. There didn't seem to be a lot of ownership, and both sides agreed to this with regard to SVB and the collapse of that bank. What was your thought on that?
Ownership?
When I say ownership, with regard to Gregory Becker, the former CEO of SVB, taking any responsibility for the problems that led to the collapse of SVB?
Well, in the first instance, when a bank fails, you have to blame the management and the board. They're the first line of defense. I think that I didn't hear his testimony, but I assume he did allow that he had something to do with it, and the board did as well.
Yeah, well, he blamed the board. I'm sorry. Go ahead.
I was going to say, I'm not trying to blame anybody. I'm saying that I think that the board and the management are the people you look to first when a bank fails. They're the first line of defense. And certainly when I was at the FDIC, that would be the first thing that I would look at is what did management do? What did the board of directors do? I think it's fair to also look at what the regulators did and when they did it. And I think they were very slow to the switch here. The state regulator, the California Banking Department, and the Federal Reserve Bank of San Francisco were very slow to take actions here. And I think they could have acted a lot sooner and should have. And so I think there's plenty of blame to go around here. Also, you had the Federal Reserve, which it was very relaxed on monetary policy. It was asleep actually on monetary policy, and the Congress was not at all attentive to fiscal policy, and they had a lot to do with what happened in this bank and other banks that got into trouble. So there's a variety of institutions and people who are responsible in some way for what has happened here.
So I got to ask you, now the Fed did take some responsibility. Jerome Powell, Fed chair, speaking out at the last press conference about failures with regard to the regional banking sector and the problems that have occurred there. But what is your advice to regulators about what they should do? Should there be increased oversight? What's your advice?
I don't think we need a lot more regulations. Congress always reacts when you have a crisis like this. They react and say, well, let's put some more regulations in place. If anything, we probably have too many regulations in place and people can't keep track of them. But I do believe that bank supervision and examination has to be a lot stronger. We have to be on the scene much more, and we have to, but when there's something wrong or about to go wrong, we need to get on it quickly and take strong actions. That was not done here. The banks that failed in this round they had plenty of signs of trouble, and the regulators were not taking swift, stern action, and that's always important. The sooner you act on these things, the lower the losses are going to be, the less likely the failure will be. So I really think that we've got to improve bank supervision and regulation. That doesn't require more statutes. That requires more training and more rigor, maybe more people.
And I got to ask you, the last time you were on, you predicted that there would be more failures after SVB. That was before First Republic failed. Do you see more to come?
It's been a long time since we had a lot of bank failures. Back in the 80s, when I was chairman, we had 5,000 failures during that decade because it was a horrible decade. We had 2 decades before it with lots of inflation and lots of ease with monetary policy, and fiscal policy was expansive. So plus we were a highly regulated banking industry, and all of the regulations had to come off. Particularly the interest rate controls, because inflation wouldn't allow them to stay in place. So we had a nightmare that we had to deal with back then, and so it takes a long time to work those things through the system. In the 80s, it took about almost 15 years to clear all those things through the system. In the 2000s, in 2008 to 2010, we had a lot fewer failures. But it still took a long time to get everything through the system. And then the Fed made a terrible mistake. It took interest rates down to near zero and kept them there for a long time, which built up a lot more problems. So that's what we're feeling now, are the effects of the Fed and the Congress. They took the deficit from 5.6 trillion at the end of the Clinton administration to 32 trillion today. That's a stunning increase in the deficit. So it's going to take time to work all that out. It took us a long time in the 80s. It's going to take us a long time now. I don't think we're at the end of the failures. I'm not going to say how many we're going to have or how fast they're going to come, but I'm confident we will have more, because with fiscal policy and monetary policy so disruptive, it's gonna take a while to get all that through the system, and it's going to be painful. When Paul Volcker was chairman of the Fed and I was chairman of the FDIC in the 80s, it was really painful for a lot of people to go through what we had to go through to get rid of inflation, and we've got to get rid of inflation. It's really difficult on older people and retirees. And people with low incomes. Inflation is a horrible disease that they shouldn't have to suffer through.
Yeah, definitely difficult for those living on a fixed income. We'll certainly talk to you again in the future. And no one likes providing a doomsday scenario. So we will certainly see what happens with regard to the banking sector and regional banks in particular. Our thanks to Bill IXIC, former FDIC chair. We appreciate you. Coming up, Bath & Body Works shares surge after beating the street with its results. Are these signs discretionary spending isn't dead in the water? We head to the NYSE next. All right, we want to do a deeper dive into the latest market action. And to help us do that, let's get to Yahoo Finance contributor Remy Blair. She's over at the New York Stock Exchange. Remy?
Well, Wall Street has been trading on both sides of flat this morning after a mixed open. Keep in mind that this does come on the heels of yesterday's market rally, which saw the Dow, Nasdaq, and S&P 500 all close higher by over 1%. In today's session, the Nasdaq continues to extend its gains and is up by about 1% as we head into the noon hour. Of course, the latest economic data releases as well as earnings are being digested this morning. We got a mixed batch of economic data. We saw existing home sales decline in April, while the Conference Board's leading economic index fell for the 13th month in a row. The Philly Fed index of factory activity also declined, and weekly jobless claims for the latest week fell as well. Of course, it's all about the implications of all this economic data in terms of the Fed's rate hike trajectory. Now, in terms of the latest earnings report, Bath and Body Works shares are surging this morning. Now, the maker of body care as well as fragrance products saw shares surge by 10%, and this came on the heels of the company reporting earnings and revenue that topped forecasts. This did come in even though sales came in softer than expected. The maker of scented candles as well as hand sanitizers, body care products, as body lotion and body wash did manage to raise its full-year guidance. Now, this week, we have been following the latest earnings out from retailers such as Target, as well as Home Depot, and we have been seeing a pullback in discretionary spending from those earnings reports. But looking at the calendar up ahead, we will be getting Lowe's results next week, as well as Foot Locker at the end of this week. So we'll be getting more insight into the American consumer spending habits.
Well, the focus has certainly been on the retailer this week. Remy Blair, our thanks to you. Meanwhile, the debt ceiling impasse has had a ripple effect across a variety of asset classes. Market participants have been cautious of treading too far into riskier assets, including alternatives like crypto. For more on that subject, we have Anthony Trenchev, co-founder and managing partner of Nexo. So, Anthony, set the stage for us. How has the debt impasse been affecting the crypto market?
Well, for those of us who have been around a little longer, with every debt ceiling debate, the U.S. is the closest it has ever been into to the abyss. And, we know how this ends, after all the rhetoric and the political capital has been maxed out on both sides of the aisle. I think there will be amicable resolution, and it will be raised, and we can return to normal. I find it insane that the credit default swaps on U.S. debt are higher than UBS, which was amidst turmoil in mid-March. I looked to short CDSs. Turns out you have to have at least $100 million to do that. So not really my risk profile, but I think the whole thing is insane. It will settle down. But the good thing is that this all is positive for crypto.
So, okay, you speak of some positives, but crypto has been experiencing what's called crypto winter. Are we still in a crypto winter?
We are. When you take the midterm view, obviously we came a long way down from the all-time highs of 70, but then again, we had more than 100% in appreciation year to date, and we still are closing to the highs of the year. I think it was very positive for Bitcoin as an asset class, the way it performed during the regional banks crisis mid-March. We saw the decoupling of the asset yet again. Crypto in general, in particular Bitcoin, which performed as the inflation and catastrophe hedge that it was designed to be. And I just think that this shows us that Bitcoin is in a class and a league of its own when compared to other crypto, maybe Ethereum as well, but a better version of gold. So obviously it's going to thrive during uncertainty, and uncertainty is the only constant we have had this past few years, and that we will continue to have in the years to come, in my humble opinion.
So I know Bitcoin has been searching to kind of break out at, say, the 30,000 level, and it's not there yet, even though it's up today. How is the macroeconomic backdrop, whether we're talking about inflation or where interest rates stand, affecting Bitcoin, Ethereum, and the broader crypto market?
Yeah, I mean, like whatever we talked about, whether it's interest rates, whether it's U.S. debt ceiling, it ultimately comes back to the Fed and, their expanding or contracting monetary policy. I think we've seen the contraction part play out to a large extent. So I, probably will have a few more modest rate hikes, but that will be about it. And then I think we will be in a sort of a permanently high plateau for a while. So this is already been priced in, and that's why we have been trading flat across the crypto for a while now, but also equities and some commodities as well. And I think that is already priced in, but we will soon start to price in what will then be imminent, and it is the late in the year lowering of rates, which I anticipate will be the response to not so high inflation. And we already saw it coming down to 4.5% in real terms. So, I think this is all good for crypto on the 1.5 to 2 year horizon.
Okay, and I got to ask you really quickly about just these meme coins. Look, they come into play, they develop a lot of just interest, they become really popular, but then some people also call them scammy. You had Dogecoin, now you have, I don't even know how to pronounce it, Pepe coin. What does that do to confidence in the crypto market?
Yeah, here I'm not going to make many friends in the crypto industry, but I think that this simply shows that we have not learned some of the lessons of the past, and people get caught up in the next cool thing and a mania, whether it's now NFTs on Bitcoin that are causing congestions of the network, whether it's other forms of insane NFTs which have zero to no utility. And actually, that is the thing that people wear as a badge of honor, that this has no utility and it's a big middle finger to, the financial system. It's all fun if you can probably exert, risk management and prudent asset management for your portfolio and your family, but this can all pretty quickly end in tears. So you have to tread with caution, but it is reminiscent of some of the stupidity that the blockchain space has exhibited in the past. So I really think it's counterproductive.
And Anthony, it would be remiss of me not to ask, crypto challenges have affected your business, particularly some legal challenges overseas in the UK. Where do you stand with those?
Oh, there are no legal challenges to speak of. In the UK, I think there was a non-news event that for some reason got reported very heavily. We dissolved 2 dormant companies that we had intention to apply for certain licenses, that then we changed plans. So really no event here. The way we go about servicing our clients on a global basis is very transparent and remains unchanged. So nothing changes for the clients. We had some positive news in towards the end of January, where we exited the United States in a manner which, caused some eyebrows, settling, with all 50 state regulators, the SEC on the federal level. Turns out this was the smart move, because we know all the charges to companies that happened in the United States with this regulatory crackdown. So I beg to differ. This has all been very positive news on the legal side of the Nexo business, and we are set up for the next bull run in crypto, which is imminent in my opinion.
All right, we'll have to leave it there. Anthony Chenchev, co-founder, managing partner of Nexo. Coming up, the FDA's recent approval of a commonly used abortion drug could be in jeopardy. We're breaking that down. The latest, that's next. A group of doctors and religious organizations were in court yesterday in a closely watched case trying to roll back the FDA's relaxed approvals on an abortion medication, mifepristone. The Supreme Court has already paused changes to the drug's approvals while the suit plays out. A conservative panel of judges in New Orleans appeals court heard their arguments. Yahoo Finance's Anjali Kimlani and Alexis Keenan join us now for a breakdown of where we stand. Alexis, you want to start?
Yeah, so let's just first talk about who the parties are in this case. You have the plaintiffs. They are a group of doctors and a group of medical organizations and religious organizations who say that the FDA's relaxed approvals, right, this is after mifepristone was originally approved, they say that it's causing injury to them because they're having to treat women who take the drug and then end up in the emergency room, and then those doctors have to treat those patients. They say they don't want to do that. On the other hand, you have the defendants who are the FDA as well as Danco, who is one of the manufacturers of the brand name mifepristone, and they say that this case shouldn't even be in court, that the plaintiffs aren't the right people to be here, and they lack standing, a legal term that allows the case to go forward. They also say that the FDA's approval is absolutely safe and that this medication should be on the market the way that it is as of now. The Supreme Court has in place a pause to keep the status quo while this case plays out. But it's important to note that this case isn't about taking the drug off the market. That's not where we are. The Fifth Circuit Court of Appeals has already said that the plaintiff's challenge to that original approval by the FDA all the way back in 2000, that is time barred. The plaintiffs didn't bring their suit early enough in order to keep that issue at hand. What they're talking about are these changes in 2016, and you can see them there on your screen. After that 2000 approval, 2016, the FDA made these relaxed access to the drug, and they did things like they changed the days of gestation. They went from 49 days where you were allowed to use this medication up into 70 days. They also changed some things about whether women had to go for in-person doctor visits and also whether they needed to have a post-treatment exam. Also changed the dosages. They went from 600 milligram dose to 200, so they brought it down. And then later in 2021, during the COVID-19 pandemic, they opened up access so the prescription could be mailed to women. They don't have to be there in person.
And that also opened up the door to telemedicine. So what this really sets up is a discussion about whether or not the FDA decided to expand access with enough data, with enough medical data, clinical data, et cetera, to back it up, and if they're safe that way. And this plays on sort of the issue that many of the companies and really the industry at large is worried about, which is questioning FDA authority. And so you heard Judge Ho really hit on that note yesterday. Listen to what he had to say.
I don't understand this theme. The FDA can do no wrong. First of all, you'll agree, that is basically the narrative you all are putting forth. Nobody should ever question the FDA. This is unprecedented. The FDA just last month, in response to litigation about the drug, a Subpart H drug for pregnant women, Makena, FDA withdrew it. In response to a New York Times headline, FDA rushed a drug for preterm births. Did FDA put speed over science? Just last year, Senator Murray, chair of the Senate Health Committee, criticizes the FDA for, quote, unacceptable, long-standing food safety failures. FDA is being blamed for the opioid crisis.
Your Honor.
I made Journal of Ethics article, how FDA failures contributed to the opioid crisis. None of this has anything to do with this case. What I'm trying to say is, why are we, it's a theme that you all are putting forth that is completely unnecessary. We are allowed to look at the FDA just like we're allowed to look at any agency. That's the role of the courts.
So as you can hear, they're setting this up to really talk about that, the FDA's authority, and saying that any argument that they are just safe from, I guess, being criticized or being analyzed is off the table there.
But so what is at stake here, and what is the financial impact we can expect from where this stands? You want to take it?
Sure, yeah. So I think that there's a lot of parties involved here, right? You have first thinking about patients, those who want to use the drug. They could have financial consequences of having to travel in order to obtain this medication if it is more limited. Then you have the doctors and the medical organizations arguing here. Doctors are saying that their malpractice insurance goes up when they have to treat these types of patients. Also, the organizations in this case, they're saying that their resources are being diverted away because they are having to spend money on this type of care when they they'd rather spend it elsewhere. And then, of course, you have the pharmaceutical corporations. You have Danco here, the manufacturer. They're saying in court yesterday that this case is an existential threat to their entire business. But then on the other hand, Danco has also given us a statement this morning. They're telling Yahoo Finance, we do not want to prejudge the ruling that will come from yesterday's hearing, but the ruling could potentially be disadvantageous, that is, to Danco's financial position. So dialing it back a bit there, but certainly it would have consequences.
Yeah, and I mean, I think why the outcry is happening right now, too, is you put it in the context of this is the biggest legal challenge that we've seen since Roe v. Wade. It just, you know, it's hard not to like really focus in and see this as a big issue because we saw what happened there, and you never thought you were going to see that happen.
That's right. That's right. So. And one of the judges did speak to that, saying that this is a very big issue. So the judges, I should say, are certainly aware. But this is a conservative group panel. This will be a 3-judge panel deciding this case. And I think the expectation is that no matter what happens, that the Supreme Court will then see this matter on their desk as well.
Wow, we will certainly continue to follow this. Our thanks to Anjali and Alexis. Thank you so much for that. Coming up, what Walmart's latest earnings report tells us about the state of the consumer. We hear from the CFO. That's next. Shares of Walmart trading pretty range-bound after Q1 earnings came in stronger than expected. Shares were higher initially. The retailer beat on the top and bottom line and lifted full-year guidance, seeing strength in the grocery segment offsetting a weaker performance in apparel and electronics. Walmart's e-commerce business jumping over the last year. Our morning team caught up with Walmart CFO John David Rainey. Let's take a listen.
We had a really strong quarter. We're pleased that revenue, our top line, was able to grow over 7%. But I think very importantly, we saw that our operating income grew at 17%. And what this demonstrates is that the value proposition, our value proposition, is really resonating with customers. But we continue to see, as you noted, a mix shift in our business. As consumer wallets are stretched more thinly, they're shifting more of their dollars to purchasing items like food and consumables and less away from general merchandise. And overall, that does have an impact on our business because general merchandise tends to be higher margin for us. But even despite that, we were able to grow operating income in the quarter 17% and increased our guidance for the year as well.
John David, Brian here. Good to get some time with you. You mentioned on the analyst call this morning that sales moderated as the quarter progressed. Why do you think that was the case? And then bigger picture, how financially stressed is the core U.S. shopper at Walmart?
Yeah, the moderation did occur in the quarter, and there's a couple reasons, Brian, to point to. I think one is just headline inflation rates are coming down. That affects our revenue numbers as well. We're beginning to lap some of those periods of higher inflation last year, but there were also a couple key trends in the quarter that affected our business and the macro economy at large. And so one of those I'd point to is SNAP benefits. Those abated during the quarter, and that we tend to see that spending patterns follow that as well. We also saw overall for the quarter a reduction in year-over-year tax refunds. And the way that played out in the quarter, earlier in the quarter, we were seeing increases in year-over-year tax refunds. For the quarter in total, it was down 10 or 11%. And again, spending trends followed that. And then lastly, and this was a good guy for us, but we saw an increase related to the cost of living adjustment with Social Security. And that happened earlier in the quarter. And so all these things combined kind of impacted the cadence of revenue growth in the quarter. And so February started off really strong, and then we saw a little bit of a drop down in March and April.
John David, Brad here. Would love to know in terms of the digital and the e-commerce business, and you've invested so much into that over the past 7 to 10 years, and it's really paying off here over time. I'm just wondering, as you think about further investment into that technological touch point with your end consumer, how you're seeing some of the members of your rewards program or those that are kind of closest to Walmart as a subscriber base, how they're continuing to engage with the brand and where they're even continuing to spend on an average basis, if there's any figures that kind of have been elucidated over that time in the investment in technology.
Sure. Well, our e-commerce business was up 26% in the quarter, and I feel like we're really hitting our stride here. Our value proposition is resonating, but it's not just around price. It's also around convenience, and that matters irrespective of what your income level is. And so things like online pickup and delivery continue to grow at much faster rates than the rest of our business. And when you have value like that, when we provide value like that to our customers, you're willing to subscribe to a membership where you have the utility in that. And what we see among those members is that about 50% of them actually come from the channel of online pickup and delivery. And the spending related to that they are appreciably higher than what an average Walmart customer is. So we want more people to avail themselves of the suite of benefits that we provide for our customers.
John David, how concerned are you that you guys mentioned on the earnings release, still seeing double-digit food inflation? Now, we have gotten a series of rate hikes over the past year and a half. Supply chains have improved, but we're still hearing from Walmart double-digit inflation. What's causing this, and any relief in sight?
Sure. Well, our guidance for the year really has sort of finally balances a cautious outlook on the consumer with some conviction in our own ability to execute on our strategy. But you're exactly right. If you look at the headline numbers, sure, inflation is coming down because we're lapping higher prices last year. But if you're a consumer going to buy a basket of groceries, prices are still high. If you look at food prices on a 2-year stack basis, they're still up 20%. And so pocketbooks are pinched, and that's causing customers to be more discretionary with these larger ticket items like electronics, TVs, home and apparel.
You said on the call that you are seeing signs of stress on consumers below the surface. Is that the kind of thing that you're talking about? What else can you tell us about those signs of stress?
Yeah, it's the same thing that we saw in the prior couple quarters as well. When consumers are coming to our stores, we're seeing trade downs in terms of buying less expensive meats, or instead of buying a pack of 12, they're buying a pack of 6. You can see that their wallets are being stretched more thinly. And when you look broadly, I look at the same economic data that you do, but there are other indicators. We're seeing credit as a funding instrument, as an example, be more elevated to where it was in prior periods. You're seeing delinquency rates on credit cards in general tick up. And so there are these signs that there's some fraying in terms of the consumer health, and we're keeping a cautious outlook on that. There's a lot that we don't know about the back half of the year, and we want to be prepared for any type of economic environment.
Well, are you still watching? I hope you are. 6 months later, Netflix also hopes you are, and it seems that you are. Netflix's ad-supported tier is beginning to show some signs of life. The streamer revealing its ad-based plan, dubbed Basic with Ads, has 5 million global monthly active users. Let's bring in our Ali Canal, who has the details on this one.
Yes, Diane. So 5 million global monthly active users, otherwise known as MUAs. But it's important to note that Netflix did not reveal any exact subscriber figures. And also, when we talk about MUAs, that can include multiple people logged in through the same account. So an important caveat there, Netflix has reiterated that the ad tier will generate about $3 billion, or roughly 10% of overall revenue over the long term. We heard from analyst Mark Mahaney, who estimated that those targets could be reached perhaps by 2025. So still a long ways out there. But if you take a look at shares today, they are soaring on this news, up more than 9% there. And you were just seeing on your screen some of the fast facts that we learned from this virtual upfronts presentation. In addition to those 5 million global MUAs, management also revealing that the ad member base has more than doubled since earlier this year, with more than 25% of Netflix signups now choosing the ad-based plans in the countries where that plan is currently available. And then in terms of those demographics there, more than 70% between the ages of 18 and 49, that global median age at 34. So skewing a bit younger. Now remember, this is only rolled out in 12 countries so far. Here in the US, it's a price point of $6.99, so significantly less, especially when compared to some of those more premium tiers, not only for Netflix, but a lot of those competitors right now. So moving forward, it seems like shareholders are pretty optimistic from this presentation, considering the stock price, but I still think we need a few more specifics when it comes to exact revenue numbers and those subscriber numbers.
Yeah, but Wall Street giving it a thumbs up today. Speaking of stocks soaring, there's another stock soaring. That would be shares of Madison Square Garden Entertainment, up nearly 20% at the moment in today's trading session. This after posting its latest quarterly results. It marks the first quarter that MSG Entertainment is reporting as a standalone company after its spinoff from Sphere Entertainment. The company says revenue arose to $201.2 million. Operating income jumped 13% to $24.7 million. Earnings improved again to 42 cents a share. That was off of swinging back from a loss of 8 cents a share last year. So you're seeing that stock solidly on the plus side. That's it for now. I'm Diane King Hall.